Evening, everyone. Welcome to this different educative session from Kerala Society of Ophthalmic Surgeons. It's basically going to cover your personal finances. So we have Mr. Swaroop Ramaswamy, chartered accountant, who will be discussing about to plan your tax return savings, etc. Dr. Rohit Sreenath is there. He'll be talking about mutual funds and crypto. And my dear friends, Dr. Biju John and Dr. Kiran will be discussing all these things. And I'll just go introduce the speakers. Dr. Rohit Sreenath is an ophthalmologist. He did ophthalmology from CMC Coimbatore and is a gold medalist. Has run his DNP, FPR, a lot of academic achievements. IARSI gold medal in Chennai, best CP poster in APA CRS Bali 2016. And probably what you all would be more interested in is how good is he in the financial analysis and the technical aspects of trading, all those. And it's very good. From the feedback that I got from my friends and whatever I've interacted with him, is extremely good with all this. He is into FNO since 2018, cryptocurrencies in 2020. The reason why I thought of having a program like this was like our General Secretary, Dr. Gopal, when he was the General Secretary of Cochin Ophthalmic Club, had a similar program. He called it Ophthalmonics. And we had a lot of speakers, basically from Maharashtra and around. And after attending that only, I started investing in mutual funds. But Gopal and our previous General Secretary Mahesh were involved in that training program. Never went into investing in mutual funds and all, and they are now asking me what to do with. They want to go into mutual funds and all. So there is some resistance on our part as ophthalmologists or any other. Any specialty doctor, we have our reservations. Many of us, a lot of people are there, like Rohit and all, Umesh, Kiran, Biju and all, who are into investments, but a lot like me are not real novices. So it's basically for training to give people an idea as to how to invest and all. And one more reason why, the first thing that I wanted to know was, what is cryptocurrency? And is it safe to invest in it? Because there is a lot of news going around that probably the Enforcement Directorate is actually watching people who are investing in crypto. And there are some messages coming that it was introduced by the Russians, Putin, and it's going to go off like it'll just vanish off one day. So I just wanted to know. I personally wanted to know what is cryptocurrency, and is all this noise going around about cryptocurrency true or not? So from my inquiry, I got to know that Dr. Rohit is a person who can really enlighten us about the crypto scene. So this is Rohit for you. And we also have Mr. Swaroop Ramaswamy. He's a chartered accountant, and he's got more than 17 years of work experience. He's a certified internal auditor, certified in control self-assessment, certified in risk management assurance, certified information systems auditor, certified in risk and information systems control, general management program for accounting professionals, IAM Kolkata. He is an all India rank holder in chartered accountancy in inter and final exams. It's really great to have somebody like him with us. He's a college topper in intermediate exams, and he's been investing in shares and mutual funds since 2005, and has been trading in equity since 2013, and trading in derivatives as options and futures since 2015. And definitely we'll learn a lot from Mr. Swaroop. Thank you, Swaroop, for joining us. And Dr. Biju John, he's one of the senior most vitreoretinal surgeons in Kerala, and he did his MS from Medical College Trivandrum. He's got his DNB and FRCS also. He's done his phacoemulsification fellowship training, vitreoretinal surgery training, MIVS training, advanced phaco training, and all, and has got the best video award in Kerala State Ophthalmic Conference in the street 2015. And was selected into top 15 video in AOC 2017. Has got the best video presentation award in Astronomy Ophthalmica, and is a faculty in annual district conferences of KSOs from 2002 and instruction courses continuously from 2010 onwards. And he has been investing in equity and mutual funds since 2010. Welcome, Dr. Biju. And Dr. Biju and Dr. Kiran will be discussing on what Dr. Rohit and Mr. Swaroop will be presenting. And Dr. Kiran, he did his MD in ophthalmology from RP Center AIMS, and did a senior residency there also. And he got the best resident award in RP Center AIMS. And he's a consultant in glaucoma, one of the best glaucoma surgeons in India, probably in India. And he's working in precise specialty eye care at Trivandrum, and he's been investing in equity since 2013 and dabbling in cryptocurrencies since 2020. So he and Rohit can definitely enlighten us a lot on cryptocurrencies. And the stage is yours, Rohit. You can start your teaching.
At the outset, I would like to thank the Kerala Ophthalmic Society, Dr. Sreeni, Dr. Biju, Dr. Umesh, and Dr. Kiran for having me here. So before I start the session, disclaimer. So this is not an investment advice. So we are just going to have a brief discussion. And again, it is important for you to consult your financial advisor before taking any and informed decision about investing in either mutual funds or cryptocurrency. So here we are not, it's not an investment advice that we are giving. We are just, this is only for educational purpose that we are discussing here. Okay, so with this introduction, I'll just share my screen. Yeah. So is the screen visible? Shall I start?
Yeah, it's visible.
Yeah. Okay. Yeah. So I have kept the topic as "Kya mutual fund sahi hai?" So we keep getting a lot of advertisements on whenever you see the IPL match or whatever. The main thing, you get a lot of advertisements on mutual funds. Okay. So basically here I'm going to discuss about the various types of mutual funds which are available. What are ETFs? And what are the things we have to see before choosing a mutual fund? Okay, so what are the various ratios we have to see? What is an expense ratio? What is standard deviation? What are the Sharpe's ratio and the other ratios we have to see before choosing a mutual fund? And how do we diversify in a mutual fund portfolio? So that is what mainly I'll be discussing about. So to start with, what is a mutual fund? So basically a mutual fund is an investment vehicle which is made up by pooling the money collected from many investors. So there are 100 people want to invest, so all their money is pooled, and a professional investment advisor takes all the money and puts it in either equity, he puts it in either real estate, he puts it in commodities, he puts it in government bonds, or likewise various investment options are available for the mutual fund portfolio manager to manage the money. Okay, so the main objective is of any mutual fund is basically to beat the benchmark. So what is a benchmark index? So if it's a large cap fund, the benchmark index for the large cap fund is the Nifty 50 index. So if it's a mid cap fund, the benchmark can either be the Nifty next 50 or it can be the mid cap index. If it's a small cap fund, the benchmark again is the small cap index, and if it is a ELSS, usually the 500 N500 is the benchmark for the mutual fund manager to beat. Okay, so what are the main advantages of putting your money in mutual funds? What advantage do you have? What better things you get by putting money in mutual funds? So first is it is professionally managed. So we have a professional money manager who's trained in this field, who knows the market risks, who knows the market risk, who knows which stock is good for you. Okay, and the second thing is about the liquidity. Okay, so you see, if for example I want to buy one share of MRF, okay, so I have to put about 85,000 rupees into the stock market to buy a single share. Okay, so if I want to invest about 5,000 rupees in MRF, I will not be able to do it, because each share of MRF will cost around 85 to 90,000 rupees. So you have a liquidity issue. So if you through the mutual fund manager can still invest that 5,000 rupees of yours into the MRF share despite the high cost of the share. Okay, next is diversification. So it is one of the good ways to diversify from between equity, debt, and other modes of investment. Next, again, you have transparency. So you have every quarter your performance is reviewed. Your performance is reviewed by the fund manager, and you'll get the annual returns. You'll know the previous 5-year annual returns. So everything is transparent. Okay, and again, it is a low transaction cost. Again, I'll be talking about the expense ratio of various funds, how an ETF is better than an index fund, or how an ETF is better than an index fund. So why do people invest in mutual fund? Typically, they invest in mutual fund because there's an increased diversification, good liquidity, professionally managed, and they are able to participate in the investment, which usually, like I said, like an MRF share, you'll not be able to buy with 5,000, but in a mutual fund, the same amount can be put in an MRF share. Okay, so that is the main advantage. So before we choose, we should know what is a direct mutual fund, what is a regular mutual fund. So a regular mutual fund, you have a broker or an investment agent who takes your money and puts it into the AMC. AMC stands for Asset Management Company. So you have asset management company. Among the asset management company, the SBI is the largest currently. Second is the ICICI. So again, this is based on the AUM. What is AUM? AUM stands for Asset Under Management. So by the asset under management, the largest AMC as of today is the SBI. The second is the ICICI. Third is HDFC. Okay. So in a regular fund, the broker or the investment agent takes your money and puts it into the asset management company. While in a direct fund, the money is directly invested into the asset management company. Okay, so either you can directly go through the website of the fund, like an SBI fund, you want to invest, directly go to the SBI website and invest, or you can also do it through the various apps which are available. One very important thing to remember is that you don't need a demat account to invest in mutual funds. Okay, so there are multiple apps which are available. You just require your KYC to be done. You don't need a demat account to be maintained. So demat account again has an annual maintenance charges. So all those charges can be avoided if you're a pure mutual fund investor only. So you can invest it through apps like CAMS, KFIN. You have apps like ET Money. Okay, so they can directly do the KYC and invest your money in mutual funds. So you don't need a demat account for investing in mutual funds. So next slide, I'll show you how much money difference will happen if you invest in a direct plan versus a regular plan. So there is a person A who wants to invest about 25,000 rupees. So he is planning to invest it for his retirement for 30 years. So presuming that both the direct plan and the regular plan, it gives of same mutual fund gives about 12% returns. The difference here comes in the expense ratio. So you can see that in a regular plan, the expense ratio is almost double compared to a direct plan. So you lose out 1%, and this 1% will account to almost 1.29 crores at the end of 30 years. Okay. So if you see the final corpus at the end of 30 years, which is compounded at 12% every year, minus the expense ratio, will come up to 5.17 in a regular plan, while in a direct plan, it will come up to almost 6.46 crores, which is again 1.29 crores more than a regular plan. So with the basic direct plan, you're making about 20% returns over a long period of time, say for 20-30 years. So that's the first thing you have to see, so whenever you're buying any mutual fund, first thing you have to notice is you're putting your money in a direct plan or in a regular plan. So next, you should know what are the various types of funds. Okay, you should know what is an open-ended fund, what is a closed-ended fund, what is a unit investment trust. So what is an open-ended fund? In an open-ended fund, the open-ended fund, you can buy back or redeem or sell the shares every day at the NIV, which is computed that day based on the price of the security. So usually open-ended funds do not have a lock-in period. So open-ended funds do not have a lock-in period. Closed-ended funds usually have a lock-in period. So again, for ELSS funds, the lock-in period is 3 years. So you cannot remove the capital in 3 years. And again, some companies, they have an exit load. So if you're trading in mutual funds, so it is better to hold the mutual fund for at least a year so that you don't have to pay a 1% exit load if you withdraw the amount within a year. Okay, so if it is beyond a year, the 1% exit load does not apply. Okay, so what is a closed-ended fund? So they issue the shares to the public only once. So when they are created during the IPO, so they cannot sell the shares back to the fund. They can only sell it between the buyers and sellers, but not back to the fund. So usually closed-ended funds have a lock-in period, and because of the lock-in period, the liquidity is a little poor. And because the lock-in period and the liquidity, the NAV of a closed-ended fund is usually a little lesser than a open-ended fund during the same fund. So if you're going, for example, an SBI fund, the closed-ended fund having the same portfolio as the open-ended fund will have a slightly lower NAV because of the liquidity issue, and second is the lock-in period. Okay, so next is the unit investment trust. So unit investment trust, again, they're issued to the public only once, and these are usually lock-in. There's a lock-in period. So for unit investment trust, there are lock-in periods of 5 years, 10 years, some up to even 20 years. Okay. So we'll mainly talk about ETFs today. We'll be talking about the various funds, mutual funds. Okay. UITs we are going to avoid for today. So what are the various fees a mutual fund will charge you? Okay. So for putting money in a mutual fund, so there are various expense ratios you should know. First is the expense ratio. So what does the expense ratio include? It includes the administrative fee, it includes the management fee, and it includes the commissions, the brokerage for buying and selling. Okay. So this usually the expense fees is regulated by SEBI. Okay. So for a large cap fund, the maximum expense ratio can be up to 2.5%. Okay. For an index fund, the maximum expense ratio can be up to 1.5%. For an ETF, the maximum expense ratio can be around 1%. So again, all these percentages are regulated by SEBI. So they have an expense ratio for each of these funds. Okay. Next, the main thing in our Indian scenario is the exit load. Exit load, I told you. So any mutual fund, if you are exiting before 1 year, you are going to pay 1% as the exit load or the for premature exit. Okay. So again, some funds don't have exit load also. So you'll have to check before investing which fund you're the documents before entering into the fund. Okay. So that is one thing. The main thing you have to check is the expense ratio. So again, I told you the expense ratio is different for a regular fund and a direct fund. So for a regular fund will almost be 1.5 higher than the direct fund. So that you have to take care of before investing. Okay. So next, how do we divide the various funds? Okay. So the total top 500 Nifty companies are divided into 3 parts. Okay. So the first is the Nifty 100. So the Nifty 100 includes the Nifty 50 stocks and the Nifty next 50 stocks. Then we have the mid-cap index. The mid-cap index has the Nifty mid-cap 50 and the next 100 stocks. And the remaining stocks come under the small-cap index. So for any index fund, so if it is an index fund, large-cap index fund, it has to either invest in Nifty 50, predominantly Nifty 50, and apart from that, if it wants to invest, it can invest in Nifty next 50. Again, the ratio of the percentage it has to invest in each of the companies is regulated by SEBI. Okay. So the recent regulation happened in around 2019. So based on the regulation, the percentage into each fund, into each of the indexes is taken care of. Okay. So then again, a mid-cap index, it can invest either in the top 50 mid-cap stocks or the Nifty next 50 also it can invest. So again, based on the ratio set up by SEBI. So this slide is a very interesting slide. So I just wanted to perform. So this is from your NSE website. So if you can see, just a minute. So this is the CAGR returns. Okay, so compounded annual growth rate returns for a Nifty 50 fund and a Nifty 50 equal weightage fund. Okay, so what is a equal weightage fund? So an index fund. So what happens in an index fund? So the top 50 companies are there. So in the top 50 companies, currently Reliance has a weightage of around 12%. Infosys has a weightage of around 10%. HDFC and HDFC Bank together has a weightage of around 15%. Okay. So again, based on this market capitalization of the company, each company has a percentage in a normal Nifty 50 index. But what happens in the Nifty equal weight index? In the Nifty equal weight index, equal allocation is given to all the 50 stocks. So if I have 50,000 rupees invested in Nifty 50 equal index, 1,000 rupees goes into each of the stocks. Whereas in a normal Nifty 50, if it's a normal Nifty 50 index investment, based on the percentage, 50 out of the 50,000, around 6,000 rupees goes into Reliance. So 6,000 rupees goes into HDFC Bank. Similarly, so here there's equal weightage which is given to all the 50 companies. Okay. So here you can see, so from its inception, for the last 20 years, the Nifty has given a return close to 14%. Okay. The 14% return is what is taken as the benchmark. So any mutual fund, you're going to see the performance of a mutual fund, this number is very critical. So you see the last 10 years or last 14 years or last 15 years return, it should be better than 14% to call it a good fund. Okay, that is one important number you'll have to notice. Next, we'll discuss about a few ratios. So what is important of these ratios? I'll explain. Okay, so what is this Sharpe ratio? So today we'll be discussing about 3 ratios. So before we discuss the ratios, we should know something about standard deviation. Standard deviation. So we should know what is a standard deviation, what is an alpha of the portfolio, what is the beta of the portfolio. So what is standard deviation? So if we take this as your graph, okay, so this is the mean. The central point is the mean. Okay, so how much away does the mutual fund deviate from the mean is what the standard deviation will say. Okay, so for example, mutual fund A. Okay, so the return first year is 10%. The return second year is -5%. The return third year is 15%. Okay, so this is A. Next, mutual fund B. The return for the first year is 7%. The return second year is 8%. The return third year is 9%. So here you can see that the movement away from the center of the mean. So the mean here is 8. So the movement is least here compared to this. Here there is a wide movement from 10% to -5% to 15%. So the standard deviation of the portfolio B is better than the standard deviation of the portfolio A. That is the first thing. So what does the Sharpe ratio take into consideration? It takes into consideration the average fund return minus the risk-free return. So what is the risk-free return? The risk-free return, we usually take the government bonds or the FD returns as the risk-free return, divided by the standard deviation of the fund. Okay, so I'll explain this with a simple example. Okay, so we have 2 funds. So let's take fund A. Okay, so first the average return of fund A is 15%. The risk of the government bond return is around 5%, and the standard deviation is around 5. Okay, so this fund A will give a return of 15 minus 5 divided by 5. That is 10 by 5, which is 2. So your Sharpe ratio here is 2. So what does the Sharpe ratio of 2 imply? The Sharpe ratio of 2 implies that for every unit of risk taken by the mutual fund manager, you are getting 2 times returns compared to a government bond or an FD. So that is what the Sharpe ratio is indicating. So here in the first example, we have a Sharpe ratio of 2. So second example, we have a fund B, which gives a return of 20%. Okay. So again, the risk-free return of a government bond is still the same, 5%. But the standard deviation here, what happens is 15%. So what it means that the mutual fund is very fluctuant. It can go up, down in the last 5 years. Okay. So what happens to the Sharpe ratio here? We have 20 minus 5 divided by 15, which is 15 by 15, 1. So based on this Sharpe ratio, even though the fund B is giving you a higher return, the stability, the risk taken for getting a 1 unit return, you're taking a 1 unit risk in fund B, while for getting a 2 unit return, you're taking a 1 unit risk in fund A. So based on the Sharpe ratio, fund A is a better performing fund than a fund B. Okay, so am I clear here? Any doubts till now? So this is very important. One of the very important ratios we have to take into consideration before choosing a mutual fund. Okay, so you should not go just by the absolute return, the last 5-year return, the last 10-year CAGR. Okay, so you also have to take into consideration the Sharpe ratio. I said why the importance of the Sharpe ratio comes in picture. That is because it's taking the standard deviation into consideration, which takes the amount of risk you're taking for getting 1 unit of return. Okay. So next is another very important ratio, which is known as the Taylor's ratio. Okay, so the Trainer's ratio is similar to the Sharpe ratio. The numerator, if you see, is almost the same. Okay, so portfolio return minus risk-free return divided by beta. So what is the beta of the portfolio? So what is the beta of the portfolio? So any beta is the volatility index. So how volatile is your asset in compared to the benchmark? So I have a large cap fund. For example, I have a large cap fund A. Okay, and the volatility index of the large cap fund is 2 in comparison to the Nifty index. Okay, in comparison to the Nifty index, it is 2. Okay, so we will see the Trainer's ratio how it is. Okay, so presuming that the fund is giving a return of 15% per year. So again, the risk-free return is the same government bond, which is giving around 5%. So 15 minus 5 divided by 2, which is 10 divided by 2, which is 5. Okay, so the Sharpe's ratio and the Trainer's ratio is almost same. The Sharpe's ratio is only considering the denominator is different. What is the denominator? In the Sharpe's ratio, the denominator is the standard deviation, while in the Trainer's ratio, the denominator is the volatility index or the beta of the portfolio. So beta indicates how volatile a portfolio is in comparison to its benchmark. So in case of a large cap fund, a beta of 2 for a large cap fund, it means that it is 2 times more volatile than the index or the Nifty 50 fund. Okay, so these are another important ratio. So again, with examples I'll give. So in example A, again same. This is example A. Let's take another example. Example B. So this here again, it's performing at a rate of 20%, but the beta is very high. The beta is around 5%. Okay, the beta is around 5. So what happens to the Trainer's ratio here? The Trainer's ratio will be 20 minus 5 divided by 5, which is 15 by 5, which is 3. Again, here you can see, because the volatility is higher, even though the return is higher, the Trainer's ratio is on the lower side. So fund A is better than fund B, despite having a lower return. So this is another important aspect you'll have to see. Okay, so just see the numbers, absolute numbers, and compare the numbers with the benchmark. Okay, so you'll have a fair idea. So I'll explain it with an example towards the end. So where to check the Trainer's ratio, where to check the Sharpe's ratio, where to check the standard deviation. So that I'll be showing in the end. Okay, so first let's discuss the theory. Okay, so what is the difference? Basically, the difference between the Trainer's ratio and the Sharpe's ratio, the numerator is the same. It is the portfolio risk minus the risk-free return, but the denominator is different. So in the Sharpe's, we are taking the standard deviation, which is both the systemic and the non-systemic risk. While the Trainer's ratio, we're checking only the systemic risk or the beta of the portfolio. Okay, so that is the basic difference. So both have equal utilization while checking for a portfolio. So next is the Jensen's measure. The Jensen's measure is simply put, I'll not go into the theory, I'll just explain it very simple. It's also known as alpha of the portfolio. So what is alpha of a portfolio? So for example, an index fund. So we're taking a large cap fund here. So the index fund, the Nifty 50 index fund is performing at a return of 14%. And your portfolio manager A is delivering a return of 20%. So what is the alpha? The alpha is the extra return which is delivered by the fund for the systemic risk which is taken. So that the alpha of this portfolio is 20 minus 14, which is 6. So this simply means that the portfolio is outbeating the index or the Nifty 50 by 6%. Okay, so this is the alpha of the portfolio. So we just now discussed about the standard deviation. We discussed about the alpha of a portfolio. We discussed about the beta of a portfolio and the various other ratios. Okay. So I'll not go into the details, which will take a lot of time. So another important thing we'll have to see is the CRISIL rating. So again, all the CRISIL rating takes all these factors into consideration. In addition to that, it takes the superior risk score, it takes the portfolio concentration analysis, it takes the mean return and volatility, it takes the quality of the asset, it takes the liquid analysis and the exposure to the sensitive sector. So what we have to see in the CRISIL, this one rating is anything which is 3-star and above. Okay, so when we choose a portfolio or when we choose a mutual fund, we have to go in for a portfolio which has a 3-star and above rating. Okay. So before we go to the exchange traded fund, I'll show you a simple example how we choose a mutual fund. Okay. So I'll be taking you to the money control slide. So is the slide visible? Yeah. So this is the moneycontrol.com website. Okay. So in this money control website, you have to go to mutual fund section. In the mutual funds, you have to go to the performance tracker. So when you go to the performance tracker, so for example, I'm choosing an ELSS fund. Okay, I'm choosing an ELSS fund. So why I'm choosing an okay, I'll tell about that later. So ELSS fund I'm choosing. Let's go with the highest rank fund. Okay, so we have quant tax fund. Again, this is a direct plan. I told you direct plan will give you about 1.5% higher. So if you see the CRISIL rating, it has a 5-star CRISIL rating. Its 1 year return is around 48%, and for a 5 year, it has given around 25.86%. Okay, so this is the fund we are going to discuss for today. Okay, so once you open this, you can see the snapshot. You can see the CRISIL rating. You can see the overall performance of the fund. So you can see that from its inception, this fund has given around 22% in comparison to its benchmark. The benchmark here is the Nifty 500 index. The Nifty 500 index has given around 6.64%, while this fund has outperformed it around 4 times. Okay, almost 4 times it has outperformed the benchmark. Next, go to these returns. You're finished. Next, go to the analysis. When you go to the analysis, so you can see the various risk ratios which I was talking about. Okay, so this will give a fair idea of how good a fund is. Okay, so you see the standard deviation. So what did I tell you in the starting? The standard deviation has to be low. So lower the standard deviation, lower is its deviation away from the mean. Okay, so here it is slightly higher compared to its benchmarks. The benchmark volatility is around 20.34, while here it is 22.56. What about the beta of the portfolio? So the volatility of the portfolio is very low for the returns it has delivered. It has delivered 22 CAGR at from the last 10 years with a low volatility of 0.82 comparison to its index, to comparison to its benchmark, which is the Nifty 500. Next, the Sharpe ratio. So what did I tell you? The Sharpe ratio and the trainers ratio, the higher the ratio, the better it is for the fund. So it indicates that lower is the better risk adjusted returns. It indicates a better risk adjusted returns. So a higher Sharpe ratio or a higher trainers ratio indicates a better risk adjusted return. The Sharpe, I told you, will take the beta of the portfolio, while the trainers will take the standard deviation of the portfolio. So here we can see it's 1.27 times compared to its benchmark, and here it is almost double, 0.35 compared to its benchmark. And what about the alpha? So you can see the alpha, it has beaten the index by almost 18.23 times. Okay, so for an ELSS fund to almost give 3 or 4 times return, it is excellent. Okay, so this is one of the ways we see and choose a fund. Okay, so so all the parameters are satisfying here. So it is a low volatility fund. It has a very good risk adjusted rewards, and it is outperforming the benchmark by a very huge margin. Okay, so this is a very good fund. So based on our analysis, this is a very good fund. Okay, so again here you can go and you can do with the SIP calculator based on the amount you want to all this you can check. So this is all simple. You can see all the details, and also you can see the scheme details. Okay, so you'll also have to check what I told you is the expense ratio. Okay, so the expense ratio also you can check. Expense ratio, you will find it. Portfolio, you will find it. Yeah. So here you see the total exposure. So it has 45 stocks, wherein 57% of the exposure goes to the large cap, 13% goes to the mid cap, and the 21% goes to the small cap. Okay, so these are the major funds in which it has major stocks in which the fund has invested. So again, you can see the percentage holding and the return it has delivered. Okay, so the in one of these slides, you'll find the expense ratio also. So the expense ratio for this is around 0.53, which is quite low, which is good for a ELSS plan. Okay, so this is how you analyze a mutual fund. So next we go to the ETFs. So we go to the ETF slide. So ETF is another exciting way of investing in foreign market, exciting way of investing in commodities, exciting way of investing in foreign currency. You can invest in futures, you can invest in copper futures, gold futures. Okay, so this is exchange traded fund is typically a fund which can own the underlying asset. So if it is so we have something called as the Motilal Nasdaq 100 ETF. So what does that do? It invests into the Nasdaq 100 companies directly. Okay. And the best part about the ETF is the expense ratio. The expense ratio is very low. It is as low as 0.5 to 0.7%. And the performance of the ETF will mirror the asset under the asset in which it has invested. So if it is a Nifty ETF, it will mirror the returns of a Nifty. If it is a Nasdaq 100 ETF, it will mirror the returns of the Nasdaq 100 stocks. If it is a oil ETF, it will mirror the performance of the oil commodity. So again, you can put ETFs in bonds, you can put ETFs in foreign currencies, you can put in gold bars. Okay, so you have the sovereign gold ETFs. Okay, again, that gives you a 2.5% return in addition to the price appreciation. So you get a 2.5% annual return in addition to the price appreciation of gold. Okay, so these are cheaper ways with higher returns. Okay, so the ownership. So what is an ETF doing? So it is similar to a mutual fund, but in a mutual fund, what happens? The company, the shares which are owned by the company come under the NAV of a mutual fund. Okay, net asset value. But in an ETF, what happens? All the total money which is taken is again divided into a number of shares. So each unit of an ETF is similar to a share. So it can be traded on a demat account. So using a Nifty ETF, using a Bank Nifty ETF, you can sell options. You can sell a covered call. You can sell a cash secured put with a Nifty ETF. Okay. So with a lower expense ratio, you are able to mirror the performance of the underlying asset. Okay. That is the main advantage of a ETF. The best advantage of the ETF is that ETFs are traded 24/7. Okay, so you have to remember that the mutual funds are traded only during the market timings. That is from 9:15 to 3:30. But the ETF trading happens 24/7. And the performance of the ETF, again, because the ETF there is a higher exposure. They have a higher exposure to derivative market. Again, the returns are better compared to a normal equivalent index fund. So you take a Nifty index fund and you take a Nifty ETF. You can see that the returns are almost 1 to 1.5% higher with the ETF. Okay. So what are the main advantages? I told you the exit load is very low. Okay. The expense ratio is very low. It is traded 24/7. And again, with the underlying, you can sell covered calls, you can sell cash secured put. So you can enter the derivative market with an ETF. Okay. And again, what are the cons? Like stock market, it takes about 2 days for settlement. So the after selling an ETF, the amount will credited after 2 days. Again, the bid-ask spread is not that bad in our Indian markets because of the huge volatility. Okay, this is more so in a US market. Okay, so usually the liquidity is very good, excellent. In fact, with a Nifty ETF or a Bank Nifty ETF. Okay, Bank Nifty Bs, the liquidity is excellent. So the bid-ask spread is very low. Okay, so like I said, it can be traded 24/7, and ETFs, again, they have a lower expense ratio and they mirror the underlying in which it is invested. Okay, so this is the difference. Again, remember that the index funds are professionally managed. So there is a fund manager who will be constantly buying and selling based on the market condition. But in an ETF, what happens? It is just buying whatever index. So for example, if it's a Nifty 50 ETF, it is buying the Nifty 50 stocks in the ratio of their market capitalization. So it is more passive. It is a mode of a passive investment. And again, because the investment cost, because it is not the fund manager is not constantly monitoring the price value, the cost is low. The expense ratio is lower compared to an index fund. So to summarize, I just want to finish with this slide. Sorry. Yeah. So how do you select a mutual fund? So just give me a minute. Yeah. So before starting any investment, this is the golden rule I follow. So always have a concrete plan. So what do you want to invest the money for? Is it your retirement fund? Is it for the education of your son or daughter? Or is it for your travel plan? Or is it for buying a new car? Or is it for buying a new home? So always have a target. Always have a target. So when you have a target, it is more easily achievable. First thing is, always set up an objective for investment. So if it's for a son's education or a daughter's education, have this much amount of money set, 5,000 rupees, 10,000 rupees monthly. It has to go, and it has to be systematically going into the market on a specified date. Okay. So have realistic expectations. So you cannot invest in an index fund and expect 20-30% return. So as we have seen, Nifty 50 fund is giving around 14% return. So you can expect around 10 to 12% return. So have realistic expectations and have a right portfolio mix. Again, I'll tell you how to choose based on the age, how much percent has to go into equity and how much percent has to go into debt. There are a few rules which I've made, so that I'll show you in the next slide. And shortlist the top funds. I showed you how we shortlist the fund. So based on the 5-year, 10-year return of the fund, based on the CRISIL rating of the fund, then you'll have to check for the standard deviation, the alpha, the beta of the fund, and the Sharpe ratio, Trainer's ratio. So based on all these parameters, we are going to shortlist the best performing fund in the sector. Okay, and don't have too many funds. So if you're an exclusive mutual fund investor, have one large cap fund, one mid cap fund, one small cap, and ELSS. So ELSS, I feel it is mandatory, because see what happens when in an ELSS market, the mutual fund manager has around 500 stocks to choose from. So the variety he has compared to a large cap or a small cap investor is very huge. Okay, so if you go back and you compare the returns of an ELSS with a large cap or a small cap over a long period of time, let's say 10 years, 20 years, so you see the ELSS, most of the good performing funds have given 20% and above. So that is because they have a wider basket to choose from. Okay, so I think ELSS is one of the easier ways to invest. So I told you how to choose your ELSS fund. So see all these ratios and see all the this one, and you can go and select your fund. Okay, so have an ELSS fund, and always NPS is a good option if you want to save additional 50,000 under this one. So Swaroop will be discussing all of that in more detail. Okay, and again, see the alpha of the portfolios, check for the beta of the portfolio, see your Sharpe ratio. Okay, and then take a call on which fund to invest. Okay, so I'll just brief you about a rule called as, just why is this not, just a minute. Is this slide seen? Is this, yeah. Okay. So what is the rule of 72 state? The rule of 72 states that okay. So 72 divided by the asset class. So for example, a mutual fund is giving you 12% returns. So it states how many years it is taking for the amount to double. So if it is a 12% return, so 72 divided by 12 is 6. So it takes approximately 6 years for the amount to initial corpus to double. Okay, so if you have invested 1 lakh in a mutual fund which is delivering around 12% return, it will take around 6 years for the same amount to double. So this is the rule of 72. So in addition to the rule of 72, we have something called as rule of 144 and rule of 44. So what does that indicate? So the rule of 144, what it says is how much time it takes for the asset to triple. Okay. So for example, a portfolio is delivering 12% return. So 114 by 12 is the duration it will take for the asset to triple in its value. And the rule 144 states how much time it will take for the portfolio to quadruple or become 4 times. So if it is 12%, it is 144 divided by 12. Again, 12 years it is taking for the portfolio to become 4 times with the rule 144. Next is the rule of 70. So what does the rule of 70 state? So rule of 70 states that, so for example, if we take the current inflation rate as 7%, so 70 divided by 7. So that is the duration it will take for your current asset to be half its value. So for example, today I have a 100 rupees note. I'm able to go and buy a dairy milk. Okay. So after 10 years, the same dairy milk, I'll have to pay 200 rupees. Okay. So that is the time it is taken for the asset to become half in its value. Okay. I'm not talking the number term. I'm talking about the purchasing power of the asset. Okay. So next is the 10:5:3 rule. So what is this simple rule? So it states that 10% has to be invested in equities, 5% in bonds, and 3% you should have liquid. And emergency fund, usually I advise 3 to 6, minimum 6%, 6 months of your expense should be there in your SB account or in your liquid funds for short-term emergencies. Okay. So that is one of the emergency rule I follow. Next is the 100 minus age rule. So this is a very important rule. So presuming your age is 35. Okay. So 100 minus 35, 65 is the percentage you have to allot in equity. So 65% is the percentage you will have to allot in equity, and 35 is the percentage you will have to allot in debt. Debt can either be in the form of FDs, it can be in form of debt bonds, it can be in sovereign gold bonds, sovereign bonds. Okay, so any form of debt instruments, 35% of your money has to go. Okay, so this is the 100 minus age rule. And next important thing is the pay yourself rule. Okay, so what it means that so you have to at least 10% of your total monthly income has to be going into a systematic plan. So for example, 5,000 rupees I'm going to invest annually at 8.5% return. So at the age of 30 years, the total corpus will come up to 2.5 crores. Okay. So minimum 10% of your total monthly income which you are generating or this one has to go into your long-term savings for your retirement plan, your children's education plan, or other kind of this one. So next is the 4% withdrawal rule. So what does 4% withdrawal do indicate? So for example, I have a retirement corpus of 1 crore. So if I withdraw 4% of that amount, that is 33,000 if I withdraw every month. So I have to compound at a rate of 7% in order, I have to, and taking the inflation at 7%, I have to compound at a rate of 7% for it to be enough for me for the next 30 years. Okay. So this is the 4% withdrawal rule. So every 33,000, with the initial corpus of 1 crore, every 33,000 I'm withdrawing every month. So I have to beat the 7% inflation in order to take care of the money for the next 30 years. Okay. So the last rule is not applicable for the Indian scenario. Okay. So this is this one. So it is called as the millionaire's rule. So age into your pre-tax income divided by 10. So for example, my monthly annual income is 10 lakhs and my age is 30. So 30 into 10 divided by 10. So my net worth should be more than 30 lakhs for at my age to be in the top 1%. So that is the net worth rule. Okay. So with this, I think I'll finish the session. Okay. So the first session, I'll like to, any questions, we can take the questions up now. Or any slide you want me to discuss again, you can ask me.
Rohit.
That second last slide, I think it's a picture which is worth sharing. I think anyway we'll have this, so I think we'll take a photograph and keep that.
Yeah, I'll do that.
Yeah, this will be available to watch on YouTube at any time. So
yeah, so this
should be okay. Now, I just that was an excellent presentation, Dr. Rohit. I just wanted to ask a couple of things. One is directly from the chat box we have, Dr. Thomas George. So he was actually looking at that particular the Quant ELSS fund, and he was looking at the graph in comparisons to its benchmark. And he's saying that the quant graph seems to take off at around after 2020 compared to the benchmark. So he was asking, since that is a sudden increase in alpha in returns after 2020, so he feels does it not skew the 10-year returns?
See, what happens is, most of these ratios, all the ratios, in fact, your alpha, beta, standard deviation, all your ratios, they are based on the retrospective performance of the fund. So the last 10-year performance or the last 20-year performance of the fund will determine these ratios. Okay. So this is not a guarantee that even in the future, it will deliver the similar return. Okay. So again, these ratios are to choose the best among the current available fund. Okay. So Bajaj Finance has been a 10-year 10-bagger for me. It doesn't mean that even in future, it's going to give me the same kind of return. Okay,
Yeah.
what it means that till now it has performed well. There is a high likelihood that in future also it is going to perform. So all these ratios are just these are not absolute. These do not guarantee that okay, today I put money in quant fund, not necessary that I get 20-25% return in the next 10 years, not required. But since the last 10 years, it has performed at this level, and it has a very good. And again, you should see that the CRISIL score. Okay, so if you see the just a minute. So if you see the CRISIL rating here, so the CRISIL rating, it was last update. It's from December 2020, September 2020. Yeah. So from December 2020, it has constantly been rated 5. Okay. So every quarter, the ratings are updated. So if you see every quarter, the ratings are updated. So we have to keep monitoring that. And again, take a call. Again, these ratios will be changing again based on the performance of the fund over the next 2 to 3 years. So I'm not telling that if you invest today, there is a 100% guarantee that you're going to make up this much returns. But till now, it has given a decent return and all the ratios are good. So that is the reason we have to choose a similar fund. That is what I'm trying to say.
Yeah, it's also true that the standard deviation of the fund is actually quite a little bit higher than the benchmark. True. So it has that would probably explain why at some times it had a huge increase and not.
True.
So the other thing I just wanted to ask you is, I mean, you were mentioning about large cap funds and mid cap funds and small cap funds in terms of allocating your money in mutual funds. Mm-hmm. So there has been a lot of change in. I have been investing in the mutual funds since about 2013, at which time there were hardly any direct plans. There were mostly regular plans, and then shifted all of them into direct plans towards 2015 or 2016. Mm-hmm. But what I wanted to know is, initially, by definition, large cap funds could invest in nearly the first 100 securities. And then they changed the regulations in such a way that, it is now only 50. If I'm not mistaken. And moreover, there has been a lot of restriction on the, earlier you could invest about 65% in large cap and then the rest in other caps. Now the regulations have become much more strict, isn't it?
Yeah. Earlier what was happening before 2019, so the fund managers, they didn't have any percentage allocation. So what happened earlier, a large cap fund could still invest around 20-25% in a small cap fund, a small cap stock, and get a very good return for the whole portfolio. Yes. So that was happening, and the whole purpose of dividing it into a large cap, mid cap, small cap was not there. Okay. So right. if you see prior to 2019, that is in 2016, 2017, your SBI small cap index, almost the small cap fund, it had given a return of close to 83% for the year 2017. Okay. And what happened was SEBI had stopped taking in fresh this one. They were approving only SIP mode of investment in that fund because the AUM of the fund was full. Yeah. Okay, so again, prior to 2019, there was no set standards that this much percent has to go into this kind of index. This much percent after 2019, everything was regulated. So an index fund, large cap fund cannot invest more than 10% into a small cap stock. Yeah. So that was clear by SEBI.
But I just wanted to know, but don't you think, I mean, the large number of restrictions have probably been taken to safeguard investors, but at the same time, that has kind of basically chained the fund managers to a large extent, in the sense that they cannot use their knowledge and ability to actually deliver alpha. Yeah. I just want, because what has happened is most of the large cap funds earlier have been either they have either continued as large cap funds, or some of them have actually been changed to a multi-cap funds, where where there is a lot more opportunity for the fund manager to utilize their abilities. So I just wanted to ask ask Mr. Swaroop also, because he said he has been investing since 2005. So have you changed your investing strategies? Like initially, did you invest more in large caps, and then have you changed more over to multi caps these days, or something like that?
Definitely, Kiran. I think the investment strategy is something that continuously keeps evolving, right? I think gone are the days when we can take one strategy and continue doing that for about 30 years. Right. I think we've got to be dynamic, in terms of choosing our strategy in line with the market, choosing the, funds or the asset classes that give us return. Right. 20 years back, Infosys was a great company, but nobody knew it at that point of time. Right. Today, the question is, what is the next Infosys? Likewise, if you take even the case of a mutual fund, I think some of these small cap mutual funds which were started in say 2004, 2005, if you see as of today, they've given a CAGR of about 20-23%, right? But today, what is that next small cap fund or any other fund that can? It's a very tricky question, right? So bottom line, I think we've got to be dynamic in terms of choosing our fund allocation, so that we put things in different baskets and make sure that overall the risk is taken care of.
And one more point I would like to add. I would like to just add. See, what happens in large cap, there is a very restricted basket. There's only 100 stocks from which a portfolio manager can pick. But if you see the ELSS market, ELSS this one, the portfolio manager has a basket of 500 stocks from which he can pick. So he has a higher chance of delivering the alpha compared to a large cap fund. So I don't invest in large cap. I don't invest in this one. I only invest in ELSS, and I invest in ETFs, mainly your ETFs like NASDAQ, your Greater China Fund. Okay, so those you get the advantage with such a low expense ratio. You get the advantage of mirroring the index. Okay, so recently, in fact, NASDAQ corrected the last week. I in fact increased the amount of SIP going into the fund. Okay, so again, the large cap, there's a very restricted this one stock basket from which the portfolio manager can select from.
Right.
So the chances
the amount of leeway it can make, progress it can make is also maybe limited, because in my experience also I paid a lot of returns, much more than the large caps in the small caps and the mid caps, because I think it has got a more of a leeway to go. And one more thing I just wanted to was that recently I read so many times, and in my experience also I found that over a long period of time, the passively managed fund sometimes almost catches up or even give better returns than the actively managed fund over a long time, not in a short time. In a short time, it might be the other way around. So if that is taken into account, for a layman, isn't it better to go for a passive fund rather than go for all these ratios and all these things? And if that is so, what are the choice? Can they go for a direct? Is there any direct mutual funds which are actually going for?
Yes, there are many.
Only have to go. You need an exchange ETF. For buying an ETF, you need an exchange. You need a demat account, isn't it?
Yes.
Yeah.
So if you want to invest in your Nifty, the best option will be the Nifty Bs. Okay, so the expense ratio is less than 0.3 to 0.4%. And you can always buy the Nifty Bs whenever there's a correction in the market. And once you get a lot of Nifty Bs, you can always, if you are smart enough, you can learn about derivative trading, and you can always do a cash secure put or a covered call and get rental income on that Nifty B also. So apart from the price appreciation, you can also get an additional advantage of the rental income by doing a covered call or a cash secured put. So that is a little advanced for this one. So at least you can mirror the Nifty returns by investing in Nifty Bs, the Bank Nifty returns by investing in Bank Nifty Bs. Okay, so they have a lower expense ratio, and this expense ratio over a period of time will matter. Like I showed you in the previous slide, even just 1% difference in this one will account for 1.5 crore if you take it for a period of 30 years.
Yeah, Dr. Biju, also, even if you don't have a demat account and you don't want to invest in Nifty Bs or other ETFs, you can still invest passively in passive managed funds, like in Nifty 50 index funds are there, Nifty Next 50 index funds are NN50, that's usually NN50 index funds are there. So you have the option, and these index funds also have very low expense ratio compared to any actively managed fund. And what you said is correct. Maybe over a period of time, yes, but this would be more applicable in more developed markets, I feel. In the US, obviously, everybody knows about the challenge that Warren Buffett had with a very famous fund manager about how actively managed funds are not going to, beat an index fund, and the fund manager had to actually eat humble pie before the conclusion of the duration itself. But in India, I suppose, because the markets are not as mature as in the US, it is always possible that actively managed funds, a certain percentage will.
Talking about the Indian funds itself,
yeah,
even in those cases, if you track over 20 years, you can found that it's almost matching the other thing.
Yeah, returns might actually match, but still there will be a difference of almost 1 or even 2% because of the expense ratio of the index funds also, being very low. So eventually the returns might match to a large extent. But as I said, you can invest in index funds even if you don't have, demat accounts to invest in these. And I also wanted to say, because for the beginners, that if you want to choose something, an ETF, you could probably choose one with high trading volumes, just like Dr. Rohit mentioned, like Nifty Bs, because the ones with high trading volumes are the ones with the best liquidity and the lowest bid-ask spread.
Kiran, I think we'll go to the next presentation.
Sure. Yeah, sure.
Mr. Swaroop.
All right, thank you. Thanks to, again, Kerala Ophthalmic Society for inviting me. Thanks to Dr. Rohit, Dr. Sreeni, Dr. Kiran, and Dr. Biju for having me here. So what I wanted to do today was talk a little bit about the tax impact of the share market, right, in terms of our trading. So is my screen visible? Okay, great. So again, this is not to be considered, again, from a disclaimer point of view, this is not to be considered as a tax advisory or anything like that. So please consult your chartered accountant before you file your income tax returns. What I want to do today is just at a high level, clear out some of the doubts in terms of how taxation is applicable for transactions or trading that we do on equity shares, right? So with that, here, the broadly two routes in which the equity shares are taxed, if you will, right? So one is from a capital gain perspective. Capital gains is again of two types, short term and long term. And then the second category is what we call as profits and gains from business or profession. So in other words, it is kind of business income. You can look at it that way. So these are the only two routes in which gains from shares or trading in shares is taxed. But the bigger question that comes up is, which route should I take, right, when I'm filing my income tax returns? So that is the question where there's a lot of confusion, if you will. So let's look at each of these, right? So from a capital gain perspective, there is as I said, there are two things, right? One is a short-term capital gain, the other is a long-term capital gain. So what's a short-term capital gain? So if I buy any equity share, let's say a share of Infosys, and sell it within 12 months of my purchase, then the gain that comes out of that will be categorized as a short-term capital gain. And if I make a loss, it is considered as a short-term capital loss. Now, the advantage with choosing this route under capital gains is that any tax that I pay on a short-term capital gain is fixed at a rate of 15%. Now, as you know, income tax is taxed at various slabs. There is someone who can fall at a 10%, 20%, 30% slab. However, irrespective of whichever slab the person is at, any income from short-term capital gain will be taxed only at 15%. So that's an advantage, right? So I could be in a 30% bracket, but I will still have to pay lesser tax when it comes to a short-term capital gain. So that's how a short-term capital gain is taxed. Now, on the other hand, there could also be a short-term capital loss, which is, let's say I buy a share of Infosys at, let's say, 2,000 rupees, but I end up selling it in 6 months or 8 months at a lesser price, let's say 1,800 rupees. So I've made a 200 rupee loss. So what happens in such cases is that I can offset this loss against a profit that I have made on any other capital asset. Let's say a profit from a sale of any other share, right? It can be a short-term capital gain or a long-term capital gain. The losses from a short-term transaction can be set off against both, right? Now, what happens in case I made a total loss in a year, right? I mean, can I do anything about it? So any loss that I make under a short-term category, I can carry it forward for 8 years, right? And in the subsequent years, whenever I have a profit, I can set off this loss against the profit of that year. So there is a benefit given on that as well. However, the very important thing that people miss out on is, if I have to carry forward my loss for 8 years, I need to make sure that my income tax return is filed within the due date. If I delay filing my income tax return, I cannot carry forward my losses. right? So that is something that needs to be absolutely taken care of. And the reason I say that is because a lot of us assessees, or a lot of people who file income tax returns, they wait until the last moment to file the income tax returns. And sometimes they are even hopeful that income tax department will provide an extension of a month, 2 months, and things like that, just as it happened during the COVID time. I just want to mention that that does not happen all the time. So we need to be careful to file our income tax returns within the due date. So that is around the short-term capital gain and loss. Now moving on, the next category is long-term capital gain. So this is the other side, right? Very simple. If I purchase an equity, if I purchase a share of any company and sell it after 12 months, which means I've held it, in my demat account for more than 1 year, that would be considered as a long-term capital gain. So anything about 12 months is considered as long-term, right? Now, one interesting thing that the income tax department has brought in the last couple of years is that any long-term capital gain up to 1 lakh in a year is tax-free, right? So anything that is over and above 1 lakh is what can be taxed. Now, there is a lot of tax planning that can be done just to make sure that I do not lose the benefit of the 1 lakh. For instance, let's say I'm sitting with a profit of 1 lakh, which is a long-term capital gain of 1 lakh at the end of the year. One can potentially look to sell those shares and immediately buy it back the next day, right? So what would happen is, in that particular accounting year, you would have a profit of, let's say, about 1 lakh, but you don't have to pay any tax on that, right? So there's a lot of tax planning of those kinds that can be done based on this benefit of 1 lakh. Now, similarly, there is also a long-term capital loss. So I've held a share for more than 12 months. However, the share has gone below the purchase price, right? So I have to go ahead and sell it off. That is a long-term capital loss. Now, a long-term capital loss can be set off only against a long-term capital gain. It cannot be set off against a short-term capital gain, right? So that's a difference between both of this. Again, I'm sorry, I'm getting a little bit technical on this, but that's one of the key requirements. Again, from a long-term capital loss as well, anything that is not set off in the current year can be carried forward for 8 years. However, the requirement again here is that the income tax return needs to be filed within the due date. Now, we've looked at a long-term capital gain and long-term capital loss both under the category of capital gains. Typically, this will apply whenever I have purchased, let's say, share, a mutual fund, or any unit that has got transferred to my account. That's when a capital gain requirement will arise. Now, the next category is what we call as business income. Now, the biggest question is, again, in what situation can I consider my transaction as a business income, and when should I classify it as a capital gain? Now, there has been a lot of debate and confusion both at an income taxpayers level and also at a government level in terms of going back and forth on this, right? So what they have now come up with and said is that, as per the budget a couple of years back, if there is a significant share trading activity, that is the specific term used, if there is a significant share trading activity, the income from that is typically classified as income from business. Now, what does this term significant share trading activity mean, right? It means typically that irrespective of whether I have traded in futures and options, or whether I have bought and sold shares, if I am in the business of buying and selling shares and I'm doing that regularly, then it is easy for me to demonstrate that there is significant share trading activity. And when that happens, I can choose to file my returns under the category of business income, right? Now, it is, the government has really given that flexibility to the taxpayer, saying that, the taxpayer can choose if they want to categorize themselves under a business income or a capital gain for their transactions. However, once the taxpayer chooses to classify their transactions on sale and purchase of equity shares under business income in a particular year, they cannot change back and forth between capital gains and business income. They have to continue that category under business income. And likewise, if in a particular year they choose to classify themselves under, or choose to classify their transactions under a capital gain, they have to continue under that. They cannot keep shifting back and forth depending on which option can be more profitable, if you will, right? so that is how it is divided between that. Now it also goes unsaid that any transactions that we do under F&O, which is futures and options, will by default be classified as business income. It will not go under capital gains, because that is another area of confusion. Right now, what are the advantages of putting it under business income and capital gain? Right, so in business income, what happens is that when you treat the sale and purchase of shares under business income, you can deduct or reduce the associated expenses, right, and then reduce your profit accordingly. For instance, let's say I'm trading in day trading in shares, right, for which, let's say, I have a dedicated laptop, I have a dedicated lease line, I have a dedicated landline with my broker. So expenses related directly to trading, let's say I run my broadband internet, right, so those expenses can be directly considered as business income, and they can be reduced from my profit, and I need to pay tax only on the remaining amount. Right, so that option also applies to capital gains, but again, it can be allowed for deduction in certain situations. Right, so that is the bigger advantage of classifying something under a business income. Now, when it comes under a business income, the normal tax slabs would also apply. For instance, right, let's say a person is already under a 30% bracket, right, any income that comes under business income will automatically get taxed at 30%. The requirement or the benefit of taxing something at a 15% for a short-term capital loss, that benefit will be lost. So a taxpayer really has to figure out which category they fall under, and then properly assess their returns and their future plan of action in terms of trading, and classify themselves accordingly. Right, so that's really at a high level in terms of how we should classify our income and trading activity under capital gains or business income. I have kept it at a very high level. I've not gone into a lot of details on this, just in the interest of time, and trying to make this more of a technical discussion and things like that. So I'll stop there and see Kiran, if there are any questions or any questions from anyone else on the panel.
See, you said this business income categorization and capital income categorization. You can't change it within a year, but can you do it like your activity this year is business income, next year it is capital gains?
No.
So
no. So in a particular year, if you choose that, okay, I'm trading regularly in equity shares and I'm going to classify that as business income, you have to continue that forever. That is how it has been stated today. Right now, there could be changes in the provisions in our budget, in subsequent years, which may allow a person to, shift back and forth. But as it stands today, the law is very clear that once it is classified under a particular category in a particular year, you cannot keep shifting back and forth.
Yeah, one question regarding the adjustment. That capital loss or capital gain by the shares from the equity or the mutual fund, can it be adjusted against the gain from business?
Swaroop, you can unshare.
Sure.
Business profit or business loss. So can that be adjusted against the capital loss or gains in equity and mutual fund?
Yeah, so there are rules around which, what can be set off against what. So yes, to some extent, the profits from one business income and capital gains can be set off against each other. Again, there are rules specifically against whether it can be set off against long-term capital loss, short-term capital loss, and things like that. So that's getting into more details, but the short answer is yes, there are provisions where it can be used to set off.
Yeah, because just wanted to bring in, because that is something which I think many of the people working in the private sector would be interested in. So that is why I just wanted to.
Absolutely.
Mr. Swaroop, how does anybody determine what is significant trading activity? What does that happen? What is that? There is no metric at all. Significant trading activity.
Yeah. So it's a very good question, right? So there is no, should I say, a defined line that says, okay, if I cross this line, I will be considered as significant, or if I am on the other side of the line, I will not be considered significant. So, the general rule of thumb is this, right? I mean, again, so where does this really play a part? Let's look at that, right? See, this plays a part, let's say, when my income tax return is picked up for assessment, right? And I have to demonstrate to the assessing officer whether, I'm trading, I have a significant trading activity or not. Now, if you look at it from a layman's perspective, let's assume that I have bought and sold shares 2 times in a year or 3 times in a year. It's very difficult to convince the assessing officer that I'm doing a significant trading activity, isn't it?
Yeah.
Whereas, let's say, I keep trading, there were at least 4 or 5 transactions in a month. So that would come to about, let's say, 50, 60 transactions in a year, right? It's relatively easier to demonstrate that, number one. Number two, what is also important is a period of time, right? So when the assessing officer, let's say they pick up the return in a particular, they're going to look at again what has been the average trading activity, etc., for the previous years as well. So it's a circumstantial thing that we'll have to demonstrate to say whether I fall under that category or not.
Okay. I think there was a question in the chat box regarding indexation benefits. As far as I know, indexation benefits are only for debt funds LTCG, right? Or can you explain that, please?
Sure. So indexation benefit does not apply to shares transactions under capital gains. It applies to non-equity related capital assets. For example, land, building, those kind of things. That is when the long-term indexation benefits would apply. That also does not typically apply for shares.
Yeah, also for the debt mutual funds, which are held for more than 3 years. Yeah.
Correct.
Kiran will go to crypto. Then we'll go for discussion.
Yeah, just one question before you go to crypto. Will you be discussing, Dr. Rohit or Swaroop will be discussing something about the new taxation laws on crypto?
I'll be talking a few. There's a slide on that.
All right. Okay. Thank you. Yeah.
So, Swaroop, just one question. The dividend income also, what about the dividend income taxation?
Yeah, so dividend income will be considered under other sources, and the government of India has been changing the rules around dividend income, right? Whether it is taxed in the hands of the taxpayer or in the hands of the company. So typically there have been changes quite a few times in the last 15-20 years. As it stands today, it is the responsibility of the individual taxpayer to pay a tax on the dividend. Right, so the dividend distribution tax is not currently applicable.
And up to $1 lakh, you don't have to pay, right? Up to $1 lakh.
Correct. Post which you have to pay tax. Yeah.
So I'll start the second presentation. So we'll talk of a few points about cryptocurrency. So mainly I'll be discussing about the blockchain. So the utilities of the blockchain, where all it finds uses. Okay, and how do you select an exchange wherein you can trade cryptos, and which are the good exchanges available, and what are the coins you have to look at? Okay, because there are around 15,000 coins currently available. So do you have to look at all the coins or only a specific coin? So all that we'll be discussing today. So again, this is not an investment advice. This is just for a discussion sake. So kindly contact your professional financial advisor before taking any choice, okay, of purchase. So first point, what is a blockchain? So what is this blockchain technology? Okay, so when blockchain, for one thing we have to remember is when did the cryptocurrency enter the market? Okay, so first thing you have to remember was the 2008 subprime crisis. So the 2008 subprime crisis, there was a huge mortgage debt which was built up by the banks due to their bad loan books. Okay, so this had a cascading effect, and it kind of wiped out around 40 to 50% of the total global economy. Okay, so the main reason for the debt to pack up was the printing of the money by the Fed, the US dollar by the Fed, okay, and unregulated money going into the housing market. Okay, so that was one of the primary reasons for the collapse to occur, and this had a cascading effect. Okay, the 2008 subprime crisis or the mortgage crisis which happened there. So what happened during that time? There was a pseudonymous person called Satoshi Nakamoto. So he published a white paper called as Bitcoin, a peer-to-peer electronic cash system in 2008. So when the blockchain was first built in 2008, there was a paper which was published, and the whole purpose of getting the Bitcoin into the market was to replace the fiat currency. What is fiat currency? So your dollar and your rupee is a fiat currency. Why is it called as fiat currency? Because it is a centralized currency. It is not a decentralized system. It is a centralized system. What is a centralized system? So in India, the RBI has the right to print how much ever rupee it wants. So in the US, the Fed has the authority to pump in how much ever money it wants. So what happened during the Corona crisis? Around $3.5 trillion came into the market, came into the circulation. So there was a huge build-up of inflation which was happening due to this. Okay, so there is no regulation on the amount of money which can get into the market and get out of the market. So that was one of the primary reasons for the subprime crisis to develop. So in order to have a centralized system wherein no bank or no central authority has a control over the whole the blockchain was built. Okay, so what is this blockchain? So why is it known as a disrupted technology? So basically the blockchain is nothing but a customized digital ledger. It is known as a digital ledger. So there is a slide for that. So for example, what happens? So you open a Google spreadsheet, you make an entry sitting here, your colleague sitting in another city, say San Francisco, he makes an entry there and he approves it. So a third person sitting in another city makes another entry. He sees that the previous two entries are verified and this process goes on. Okay. So there is a chain of entries which are being made, and each entry is verified by the user of the chain. Okay, so that is the simple principle of a blockchain. So what is a blockchain? It is a digital ledger of transaction which cannot be either duplicated, very important, and it is distributed across the entire network of the computer system that exists on the blockchain. So if a blockchain has 4 systems, so all the 4 systems have to approve the transaction, and it is uniformly available on all the 4 systems to see. Okay, so this transaction, it is not a centralized, so not a single person or a single authority has a control over this network. Okay, so the network is maintained by who? The network is maintained by the people who are in charge of the blockchain. So these are known as the miners, so who have to do complex puzzles in order to for the transaction to pass on. Okay, so once the complex puzzle or mathematical equation is solved, the blockchain is secured by multiple things. One is the hashing of the blockchain. Hashing is like a digital password. Okay, then you have the private key and the public key. So all that we'll be discussing in the subsequent slides. So blockchain is a network of digital ledger having a network of transaction which cannot be duplicated or distributed, and it is uniformly available in all the systems of all the computer systems. Okay, so each time a transaction made on the blockchain, it is verified by every computer on the network. Okay, so this is a little technical. So this is how. Okay, so I've tried to keep it simple. So all network participants, they have a copy of the ledger, and that is why it is completely transparent. So it cannot be fudged, it cannot be replaced. Okay, because there is the whatever transaction is happening, all the systems on the ledger will have the complete details of the transaction which is happening. Okay, so this feature, where is it used? It is used in cases of NFT, decentralized finance platforms, DApps platforms. Okay, so all these I'll be talking in detail. Okay, so what is centralized? So till now what we have discussed, what is centralized finance? Centralized finance is your Fed printing the US dollar or your RBI printing the currency. So what is blockchain technology using? It is using a DeFi or a decentralized finance. So what it does, there cannot be unlimited number of bitcoins on the system. Okay, there's a maximum of 21 million bitcoins on the system, out of which almost 18 million have already been mined, and the next 4 million will be mined by 2040. So all that I'll be discussing in the subsequent slides. So how does this blockchain work? Okay, so first a new transaction is made, then the transaction is transmitted to a network of computers, and there is a complex mathematical equation or which has to be solved by the user for the validity of the transaction to happen. All the blocks or nodes are interconnected, so it cannot be erased, or it cannot be fudged, or it cannot be altered. So there is a central transparency which is happening there. Once the transaction is completed or it is valid, a block will be created, and the previous blocks have to be completed for the next future blocks to be added to the network. Okay, so this is the simple principle of the blockchain. Okay, so next we go to the utilities of the blockchain. So where is the blockchain most commonly used? Okay, so one of the commonly used apps, that is the CoWIN app. Okay, so if you see, so what happened? So there was a CPaaS company called as Tanla Platforms. So they were the one to use the blockchain technology in order to deliver the CoWIN messages, the vaccination messages. So if you see, once you had your vaccination injection, immediately within another 30 or 40 minutes, you would receive a SMS or a message stating that on this date, at this place, you have had the vaccination. So again, the network is transparent. The network cannot be reversed, and the network was smooth. So at one point, the app was close, doing transactions close to 10,000 to 15,000 SMS per second. Okay, so that was the speed at which the data was transferred by the app. Okay, so this was one of the utilization of the blockchain technologies, wherein the CoWIN app delivered messages to the users regarding the vaccination details. Okay, so the same thing, so once the request is made, it is sent, the transactions are funneled to the peer-to-peer network, and once it is approved by the network by complex mathematical equations, the block is set up, and for the subsequent blocks to be set up, the previous ones have to be closed, and this cannot be fudged or this cannot be replaced. So this is the blockchain technologies. So now with this introduction, we'll go to the various applications of the blockchain technology. So where all we can use the blockchain technology. Okay, so first, coming to the non-financial uses like authentication. So we know that the UN is already using the blockchain technology for the e-voting, which happens in the United Nations. So this is again powered by the blockchain technology. So for voting, for authentication, the blockchain technology can be used. Okay. Next is the real estate. So real estate, some US like Arizona and other states in the US, they are making use of the smart contracts. So what is this smart contract? So smart contract is again an Ethereum based program, so which auto executes itself. It is a computer based program which auto executes itself if the current all the requirements are met. For example, I have a piece of land to sell. Okay, I am expecting a value of 1 crore for that land. So on the blockchain, if I put the land on auction on the blockchain, so it will be executed, the program will be executed as and when I get a bidder for more than 1 lakh. So any bidder who opts for a price for more than 1 lakh will get the smart contract and it will auto execute. Okay, so this way what happens, a lot of middlemen, a lot of brokers are eliminated. So those who charge 2%, 3% on the sale value, these are eliminated, these people are eliminated. So that is one of the uses of smart contracts in real estate. Okay. Next, again, you have Internet of Data, you have in-app development. So there was one article which showed that soon blockchain will replace your Ola and your Uber. Okay, so Ola and Uber, they're usually taking around 20% commissions for acting as an intermediary between the customer and the driver. Okay, so this once it comes into the blockchain, it will be similar to your Ola and Uber app at a fractional cost. So you up to 20 to 30%, the cost will come down once the blockchain technology takes over your Ola or Uber. Okay. Next is financial transaction. So financial transaction, currency exchange. Okay. So for example, I have to transfer say $10,000 to my cousin in US. Okay. So currently, what are the various technologies which are available? So we have something called as Swift technology. So what is this Swift technology? First, I have to convert my Indian rupee into US dollars. I have to deposit into my bank. My bank uses this Swift technology, which is again US based. It charges me a commission of 5 to 10% depending upon the amount I want to transfer, and it will transfer the same amount after deducting the commission to my cousin in US. Okay, and how much time does this whole transaction process take? It takes around 6 to 8 hours on an average. Okay, so with your there is a cryptocurrency called as XRP, which is known as Ripple. So at a fraction of a cost, which is less than 0.5%. Okay, 0.5%, the whole transaction can be completed in less than a minute. Okay, so sitting in my home using the Ripple, I can transfer the same $10,000 to my cousin in US at fraction of a cost in less than a minute. Okay, so that is one of the advantages of your cryptocurrency. Again, you have USDT. Also, the charges are almost similar, even more lesser. It is around 0.2 to 0.3%. So I through my USDT account, through my wallet, I can scan and transfer the same amount by sharing the code with my cousin in US. So the same $10,000 can be transferred using USDT at a fraction of a cost. Okay, so this is how the cryptocurrency or the blockchain is replacing the conventional technology, wherein a huge margin is used, huge commission is used for the banks to process the same amount. Okay, so also currency exchange. And also now with Metaverse, you have 3D virtual games which are coming up on the blockchain, which make use of the Metaverse. So you have stocks, you have coins like decentralized land, wherein you can buy and sell virtual land on the Metaverse. Okay, so this is picking up a lot of traction. So NFTs, the NFT market, you have a app called OpenSea wherein you can buy and sell NFTs. So that is again gaining traction with the crypto market and the blockchain application. Okay, so this is the real-time utility of the blockchain, like for voting, for real estate transactions, for currency transfers. Okay, for gaming. So these are the various utilities. Again, this I've already discussed how the block is set up and how the previous block has to be closed for the next block to be generated. Okay. So this I told about the banking and finance. So what Capgemini? So so even JP Morgan, one of the largest investment bankers, have put in a huge amount into the NFT market. So they are developing a metaverse-based NFT market. For again, wherein the transaction cost will be almost one quarter or 1/4 of the current transaction cost. And Capgemini estimated that the potential savings may come up to 16 billion. Okay, in the banking and the insurance fees by using the blockchain-based apps. And cryptocurrencies, again, they are digital coins that operate without the need of a central this one. So cryptocurrencies we'll be discussing. Again, they can be used as a store of value. They can again be used for transferring money for cross-border transactions. For international transactions, they can be used. Again, smart contracts like Ethereum-based smart contracts, they are used for land registry. So they can auto-execute with once the required conditions are met. Again, for voting, I told you the DLT system can use the blockchain for voting and again maintaining the various government records. Okay, so also what happens in the court of law? So all these record keeping systems, record maintenance systems can be shifted to blockchain, which is more secure and which cannot be hacked. So all the government documents cannot be hacked. It is hack proof through the blockchain because it is always forward, and all the blocks have to be open in order to see. Because of the hashing technology and the private and the public keys, you have a secure way of maintaining records. Also e-commerce and retail stores. So I want to just mention one point here. So I told you about Ripple or XRP. So they also have, so now how we get credit card points on transacting through credit cards. So Ripple in the US, they have come up with a XRP card. So you can use that for purchasing items on retail stores. So you'll be given cash back in the form of Ripple coins. Okay, so that Ripple coins again can be redeemed for buying stuff later. Okay, so based on the transaction, instead of getting cashbacks, you're getting cashbacks in form of coins. So that again can be used for retail purchase and e-commerce purchase. So what are the cryptocurrencies? So basically, cryptocurrencies are the prime technologies which are spearheading the fourth industrial revolution. Okay, so these are the foundation of the cryptocurrency is the blockchain. So they are online transaction mechanisms. Okay, so they allow the users to make direct and secure online payments through the virtual assets. And blockchain technology, I told you, it is a digital ledger, so it cannot be replaced or it cannot be fudged or it cannot be hacked. Okay, so it is hack proof, and there are various mechanisms to secure the blockchain. Okay, so the word cryptocurrency is derived from the term cryptography. So cryptography is a method of secure encryption. So what are the various ways in which the cryptos is safe? It is by elliptical curve encryption, public keys and private keys. So what is a public key? What is a private key? So in order to safeguard your crypto, so you can either keep it in the exchange or you can keep it in a digital wallet. So for a digital wallet, it will be similar to a pen drive. So you can store it in a pen drive. You'll have a 13-digit key, which you'll have to keep safe in order to transact or sell or buy a cryptocurrency. So that is the public, that is a public key. So what is a private key? Private key, so also you can keep the currency online using a internet-based private key. So again, that also will have 13-digit number, which you'll have to keep secure in order to transact the charges. Or you can also keep it in the exchange, and some exchanges like Vault, they give up to 12.68% annual returns on the primary coins like USDT, USDC, Polygon Matic. Okay, so you get up to 12.68% annual returns on these by keeping it in the exchange. Okay, so cryptocurrencies are quite secure and they cannot be double spent or they cannot be counterfeit. Okay, so these are the main utilities of the crypto coins. So since it's a centralized, it is decentralized. So that is so the number of cryptocurrencies which are in circulation are limited. So they cannot be unlimited printing of coins. Okay. So and what is the this one, the principle of the Bitcoin? So the principle of the Bitcoin is the proof of work or the consensus mechanism. So what is this proof of work? So like I said, the miner or the person who is mining the Bitcoin has to solve complex mathematical equations. Once the mathematical equation is solved, it will create a block. Hence the name proof of work, and new coins will be generated, and a fraction of the coin will be paid to the miner as a mining fee. Okay, so this is how the new coins will get into the circulation. So this I already told you how the Bitcoin came into existence. Okay, so what are the important features of Bitcoin? So it is permissible, it is open source. So basically, as of today, Bitcoin, the number is limited to 21 million. Okay, so as of 2021, 18 million coins have already been released, and by 2040, the remaining 3 million also will get into the circulation. So when it started in 2011, 2012, it was around 85% market capitalization. So currently it has around 40% market capitalization. So the newer, so what we have to remember is Bitcoin is just as a store of value. It is available as a store of value. You cannot do smart contracts. You cannot execute smart contracts with Bitcoin. So Ethereum is taking a higher stage compared to Bitcoin currently because of the smart contract feature of the Ethereum. So newer coins like Solana also, which enable smart contracts at a lower cost compared to Ethereum and Bitcoin, are gaining a lot of traction. So again, remember, the supply is limited, so you cannot do unlimited number of coins in the circulation. So maximum at any point is 21 million. That is by 2040. And what happens with every 4 years, the amount of the mining rewards gets halved. Okay, so earlier in 2012 there was 25 bitcoins which were given as a block reward. In 2016 it halved to 12.5, and currently in 2020 the mining reward is 6.25 bitcoins. Okay, next, coming to the altcoin. So I told you Bitcoin is the alpha coin. So that is the currently having the 40% market capitalization of all the cryptocurrencies. So apart from Bitcoins, we have around 14,000 coins in the crypto market. So all good coins? No. So here is where you have to pick. Okay, so what are the various coins which have come up? So they are based on the various uses of the coins, various applications of the coins. So we have Litecoin, so which was a copy of the Bitcoin, but it had increased transaction time and better storage efficiency compared to the Bitcoin. So again, Ethereum platform, I told you, it is used for smart contracts. So the smart contracts auto execute themselves. They can be used for land registry and other for features like NFT market. For they can be used for metaverse. Okay, so other gaming, they can be used for gaming. So all these are available. Next, stable coins. So what are stable coins? Stable coins, we have Tether, which is pegged against the US dollar. So typically one Tether is worth $1. So these stable coins do not typically appreciate, in price appreciation is very less, but they can be staked for a higher FD return. So I told you USDT, the cryptocurrency exchange vault will give around 12.68% for staking it on an FD. Okay, so this is your Tether. Next, you have utility coins. We discussed about Ripple and uses of Ripple for cross-border transactions. So you also have other coins like Filecoin, which can be used for this one. Okay, so I told you what is a fork in this one. So I told you the blockchain. So if you want to modify the blockchain, so this is currently a blockchain. If you want to modify a blockchain, you can create a fork. Okay, so this fork, what happens? Again, all the participants of the blockchain must approve for the fork. Okay, for creation of a fork, it has to be valid. So again, if the requirements are met, the blockchain can either move in this direction or it can move in this direction. Okay, so again, for creation of the fork, all the participants of the blockchain have to approve. So there is a blockchain which is doing a specified work. Okay, so you want to do slight modifications in them to create a fork in the blockchain. Okay, so that is the simple definition. Okay, a few points about the taxation. Okay, so what happens? See, currently the government has slabbed it at 30%. Okay, similar to your FNO, this one. So 30% tax rate. And again, the crypto losses cannot be set off against the profit. So if you are making a loss in a single asset, you cannot offset it against another crypto profit. Okay, so that is another drawback of the current rule passed by the government. And So 30% taxation slab. So you cannot offset the losses with the gains got by other assets. Okay, and crypto, see what we have to remember is crypto is still in a nascent stage. Okay, it's not even been a decade since it has come into the existence. Okay, and it is a very fast developing market. Okay, so with the advent of metaverse, with the advent of smart contracts, so the scalability, the options of scalability is very high. Okay, so if you see the Facebook has spent close to 10 trillion. Okay, which is equal to the money spent by the top five NASDAQ companies since the last 5 years. So that much of money is going into this one. So Nike has set up a virtual store. So Tesla has invested close to 2 billion in Bitcoins. Okay. So all the top 5, top 10 NASDAQ companies are putting their money and backing the crypto. That is why there is a lot of traction which is happening. And going forward, if all the utilities which it promises to meet are met, the scope for growth, the scope for is huge. The potential is huge. Okay. So again, this is not an investment advice. I'm just we're just discussing the pros and cons of the various investments. Okay. A few points about Web 3.0. So Web 3.0. So what is happening in Web 1.0, Web 2.0? So Web 1.0, the internet came into existence. With Web 2.0, what is happening? Your YouTube, your Facebook is taking data from you and it is selling the data on the app. So how is YouTube making money? Through the ads which is put on YouTube. How is Facebook making money? Again, through the ads which are coming to this one. So again, in Web 2.0, the money is made from the user of the interface, is made by the user of the interface. Again, there is no security of data which happens in 2.0. So if you're paying your credit card bills through credit, so it is not free. What is happening is your credit score, your data of your money management is sent by credit to the banks. That is how the circle will continue. That is how it is. That is how the Web 2.0 is acting. So what is Web 3.0 promising? It is promising a decentralized this one. So your data will be more secure with Web 3.0. And some of the projects which are very interesting as of today is the Polygon. So Polygon is India's biggest cryptocurrency project. So it is got as an Ethereum scaling platform. So the conventional Ethereum is like your Internet Explorer of 90s. Okay, it's ultimately slow. Even though the smart contract happens, it happens at a very slow pace. Okay, so what is Polygon doing? Polygon is scaling up the efficiency, the speed, and the cost factor which is involved in the Ethereum projects. Okay, so that is where we see the benefits of Polygon. Then we have Terra. Terra is a decentralized finance platform wherein the payments will happen at fraction of cost compared to your conventional banking. Okay, so you can buy and in the future you can buy your mutual funds at a fraction of a cost of what you are paying now with the decentralized finance. Okay, so again you have application development like Consensus and Bioeconomy. Again, Bioeconomy is a cross-chain platform which helps in operating between multiple blockchains. Okay, so you can operate between Ethereum, Bitcoin, and XRP. Multiple platforms on a single Bioeconomy platform. Okay, so that is the advantage of Bioeconomy. So interscalable, inter-exchangeable between the platforms is happening here. Okay, so these are my references. Okay, so with this I would like to conclude. Any questions I will take up. So even though this was a little exhaustive, but I've tried to cover all the major points.
Yeah, Dr. Swaroop, I think I'll first take a question on the chat box. I have tried to answer it because of lack of time in the chat box itself. But I think because, one of the things about cryptocurrency is that the transactions are almost hack proof, isn't it? Because of the millions of copies of the ledger and the fact that these ledgers are secured by all these cryptography functionalities like hash functions and public keys and secret keys. But the problem is exchanges. Like the buyers and sellers are obviously connected through exchanges. Exchanges can be hacked, and this has happened multiple times. So that was the question with regarding. So apparently the question is that there was some news on crypto exchange platforms being hacked. Would that affect the holders? That is the question.
Can I take the
question?
Sure.
Yeah,
can I take the question?
Yeah, it's question to you.
So 4 things we have to see when we are choosing a crypto exchange platform. There are 4 things we have to be very careful. Okay, so first thing, you have to see if the exchange is secured. Okay, so usually the earlier previous exchanges were not secured. So what was happening, it was not the cryptos which were getting hacked, but the exchange itself was getting hacked. So you can see almost a few million bitcoins being hacked. Okay, so now majority of the exchange are secured with BitGo. So you have to, before choosing an exchange, so like we have NSE and BSE for stock trading, we have the various exchanges which are available. So you have to go in for a secure exchange which is secured by BitGo. That is the first thing. Again, you have various exchanges which are just available for trading, and there are exchanges which help in yield farming. What is yield farming? So exchanges like I'm currently invested in Vault. So what it gives is, it gives an additional 12.8 or 12.6% return if I FD it for a year. Okay, and again, this interest is paid month on month. Okay, so if you want to do yield farming, that is, you want to keep your cryptocurrencies in the exchange and get returns in the form of FDs which are paid back in the same coins, you can do yield farming with your exchanges. So that is one thing you can use. Or you have to keep if you have a very high amount, okay, valuable more than 40-50 lakhs, always better to have a private key or a public key. Okay, better always a private key, that is having a pen drive like thing which is available online, which you can purchase and you can secure your cryptocurrency rather than keeping it in an exchange. So when you have very high amount in your exchange, better to keep it in a cryptocurrency. But even if your exchange is hack proof, or if your exchange is secured under BitGo, there is the 99.9% of the investment comes back into your account if it is hacked, in case it is hacked.
Yeah. So can you actually name some top exchanges in India for people who want to try out, who can, which is probably, you consider reasonably secure enough?
Okay, so when I started investing in crypto, so what I found very difficult, or what I found very this one is, see, your WazirX, your Coinbase, your CoinDCX. So all these, they use MobiKwik for money transfer. So what happens is, when I'm transferring money through MobiKwik, I'm paying an additional 1.5 to 2% extra to MobiKwik as a service charge. So that is when I shifted to Vault, because Vault was the only exchange which was permitting me a direct bank transfer without this intermediate additional 1.5. And additionally, benefit you got was the yield farming I told you, which if you stake it for the FDs, you get an additional rate of interest. So all are good, but just see if before choosing the exchange, just see you're not again paying an additional 1.5 to this MobiKwik or the intermediaries which are charging for every transaction which is happening on the exchange.
Yeah, I think I just wanted to update that MobiKwik transactions has been stopped from 1st April in WazirX. They're not taking MobiKwik at all. So it's only bank transfers. And the problem with bank transfers in WazirX is that it is not supported by all the major banks. For example, SBI, HDFC, ICICI. You cannot basically, but then you can use the P2P transfer and buy USDTs.
So again, in UPI transfers, they don't allow for more than 10,000 or 20,000 transfer, and some don't even allow UPI transfer. I'm
not talking about UPI. The option with Wazir, because I'm talking about WazirX because it's the largest platform in India. As far as I know, I think the largest exchange in India.
Correct.
So the option, but then that would be a little more difficult for a beginner, would be to use a P2P option, buy USDT dollars through the P2P, and then buy Bitcoin. That would be a little roundabout way, but the advantage is that there are no transaction fees on the P2P mode.
No, but what happens is the transaction happens. But see, again, what happens in the USDT, and each time you transfer and convert it to a USDT to say a Bitcoin or this one, the transaction keeps happening, and that will be filed for that. You have to show it in your income, your filings, annual filings. That has to be shown again.
Yeah.
That
about the hacking thing, historically the major hacking happened in Tokyo in the Mt. Gox exchange, and none of the investors have gotten their money back yet. I just wanted to let you know. And also I think WazirX has been actually bought by Binance. Binance is probably the largest crypto exchange in India. But in the world, probably Binance, and Binance was also hacked in 2019. But I think they have also already had a secure asset of funds, and by which they said they will actually be taking care of all the losses of all the
60-70% only. I think they got back the investors. I don't think the full amount. But BitGo currently they say is 99.9%. They say, but that's what. If you have an insurance, better to go for the platforms which have a added insurance like BitGo.
Okay, and Just another thing. Among the coins, what is your general strategy? I mean, somebody wants to invest in a cryptocurrency for the first time. Would you suggest to invest in the top 5, maybe by market cap or something like that, or what is your strategy to advise people generally?
See, as of now, the way the crypto market is heading to, what we see is a lot of NFT market coming up. We see a lot of metaverse apps coming up. So my personal bias is towards that. Okay, because I am investing a lot into decentralized land. I'm investing into Sandbox. Okay, all the metaverse based script I'm investing. And I'm also the smart contract based. So I'm more bullish on Ethereum compared to Bitcoin. Again, Bitcoin as a store of value is definitely the alpha coin. So that some part has to go in, like it is like your TCS of Indian market or your HDFC or Reliance of your Indian market. So some allocation is going into that also. But if personally asked, I would prefer Ethereum based and Solana based platforms because they have the scalability. So that they are like the small cap and the mid cap stocks which have a high chances of scaling higher. Okay, so Polygon Matic, again, I have a very good allocation in Polygon Matic, which is again Ethereum scaling platform. Okay, so initially to begin with, I would say start with the alpha coin, the Bitcoin, and a few major coins like your Ethereum, Solana. Okay, top 5 coins to, and as you study about the other coins, know the risk and the reward, and then slowly do your SIP in these coins also.
I think about the dangers involved also, I think people need to be enlightened. What are the risks? For example, the government and the regulator doesn't take a very favorable view on this cryptocurrency.
So, see what happens. See what happens is if the government starts accepting cryptocurrency, it is like devaluing your rupee. Okay, so no government will openly accept any cryptocurrency or any, be it US, be it Fed or be it your RBI. They will always, you show me one positive comment which RBI or Fed has shown against cryptocurrency. You will not find a single one. Yeah. See, the reason being, if you are giving another alternate currency which is your competitor some value, you are like devaluing your own system. You are devaluing your own US dollar or a rupee. So which no government will agree. Okay, so there was a blanket ban on cryptocurrency in China. So what happened? So despite the blanket ban, what was earlier happening was 70% of the crypto mining was happening in China through Chinese platforms. So after the blanket ban, that didn't change. So they started using Japanese VPAs in order to do the transaction. So what happened in China was the Chinese government could not even tax them because it was a Japanese VPA, and the Chinese citizens to still do the transaction of buying and selling the cryptocurrencies. Okay, so that is the reason the Indian government did not have a total blanket ban on the cryptocurrency. What they did was they're trying to regulate it, similar to what the US is currently doing. So once the regulations come in, even definitely going down the line, the 30% bracket will come down. If it is, see what is happening is almost close to 10 lakh Indian rupee is in the crypto market. So there will definitely not be a blanket ban stating that crypto is going to shut down tomorrow, or we are going to, that is not going to happen, because up to close to 10 lakh crore of Indian currency is in the crypto market, okay, which is more than the annual budget of India. Okay, so that is one thing. And but initially when you're choosing, better to go for the stable coins like alpha coins, USDT, USDC, okay, and your Ethereum based platforms. So these are good for beginners.
Rohit, why do you see so much of fluctuation in the value of Bitcoin and other? It's huge. If you see the history, like it goes up, down, go up, down. Is it because of huge amount of speculation going on?
Yes, precisely the point. See, what happens? It is a newer asset. It is not even a decade since it's come into the existence. So it's not a stable asset. Firstly, it should be viewed as an alternative asset, and not more than 5% of your total portfolio should go into the asset. Okay. Currently, I'm having around 2.5% of my total portfolio allocation into Bitcoin. It's highly volatile. So what happened during the just prior to the Russia-Ukraine war, the whole portfolio was down by 40-50%. Okay, and now it's again within a week, it's come back to its original price. So the volatility is very high. It has a very high beta because of the lot of speculation which is happening. Okay, it is and it is still a premature market. It has to get regulated, and only once the markets get regulated, there will be stability in the market, and the price action will not be that volatile.
So what do you feel is the one? The value might be so high because of the speculation, and during a crisis it goes down. So what do you feel is probably like for Bitcoin? What should be the reasonable price level in US dollar terms?
See, that's a very difficult question to answer. The reason being, see what happened. See, when it started, when Bitcoin came into its existence, it was hardly 200, 300 rupees. It went all the way to 4,000 rupees. And now it is close to 30, 40 lakhs.
37 lakhs.
A single Bitcoin is close to 30 lakhs.
Yeah.
So by the time
it had gone up to 60 lakhs also.
60, 74 lakhs it had gone highest. Okay. So you never know. It may go up to 2 crore also. You never know. Okay. So it depends on how much the speculators take it to. Okay, so again, I would not advise to trade in cryptocurrencies. What I would advise is just have it as an alternate source of, just to diversify your portfolio. Just have a small allocation in the cryptocurrency space also. So in case the price appreciates, like how we are expecting, so from say 40 lakhs to 50 lakhs, it goes to 2 crores or 3 crores. We get the benefit of investing in that asset. Okay, rather than seeing it as an asset to trade in or make very quick money, I would rather put SIPs in the asset and wait for price appreciation over a period of time. So since it's just a decade, so maybe 1 decade or 2 decades later, definitely it's going to be 20 or 30 crores. A single Bitcoin will be 20 or 30 crores. So that is when you will be able to capture the true alpha of the crypto world.
Yes, Sreeni, there is one thing about Bitcoin, because you can only have 21 million Bitcoins. Though certainly there is a question of storehouse of value. There is a storehouse of value. The price on a daily basis would be obviously on the basis of speculation, but there is a limited amount. So that means there is a value there.
Amount for Bitcoin. Like, see, if you take the whole cryptocurrency lot itself,
yeah,
I mean, you have options there, right?
Yes. Yes.
So it will be probably like you have diamonds, you have gold, you have silver.
Yes. Yes.
So Bitcoin is gold.
But
is it that way?
Okay.
So
if you look at it,
40% of the market is Bitcoin. 40% of your crypto market is Bitcoin. So still it is almost half of your whole market. Okay. So until the other coins grow up to that level, it's still the alpha coin. Until your Ethereum or your other coin scales up to that level, it still has that effect on the market capitalization.
So that's fine. But there is a possibility that the other coins capture more of the market,
Yes.
And so that, I mean, if you take that into consideration, the cryptos as such is not limited. See, Bitcoin is limited.
Yeah.
So the crypto world is not limited.
It's not. Yeah, you see, Sreeni, you just mentioned about precious metals like diamonds, platinum, silver, gold, etc. For all the precious metals you have, still the only universal currency is gold. It's not really diamonds. Nobody is. I mean, when we were on the cusp of a complete breakdown in 1992, we actually took gold to pledge to London. So everybody accepts gold as a currency. So I mean, currently, I suppose the top, the top coins which have a huge market capitalization would be performing a similar role, in the sense that eventually these coins have to be used as some sort of a medium of exchange, right? So that is when, in fact, at one point of time, Microsoft, Tesla, they were all ready to accept some crypto coins. I don't know exactly, but I suppose
Tesla even now accepts Bitcoin. Tesla accepts Bitcoin for.
I think they have actually gone back on it, because they said that because of the environmental impact and Tesla being an environmental, they've gone back on it. Both Microsoft and Tesla have gone back on it. One problem with all these crypto coins is the huge amount of computing power, and therefore the huge amount of energy that is required to actually mine coins and all these transactions, and therefore Elon Musk decided that this is too much of an environmental impact issue, and they decided. And you spoke about volatility of Bitcoin. Actually, Bitcoin is probably one of the least volatile among all the coins, because it's the alpha coin. You take something like Dogecoin, a single tweet. Elon Musk makes a single tweet, it goes up 100%.
So those are meme coins. So basically, your Dogecoin, your Shiba Inu, these don't have an inherent value, or they do not help in any smart contract or any transaction. They're just meme coins. So any new tweet from any top this one comes, so those price starts moving. It is more of a speculative coin. So I would ask people to avoid such coins. Okay, basically your Dogecoin, your Shibu Inu, these are speculative coins. So these you never know when they raise the market, it goes all the way 10x, 20x time, and most of the retailers are trapped there. And then when the prices come down, they don't have an exit. So that's what happens in these coins. So these are the ones you have to avoid. I would personally stand with that.
Going back to
I mean, the environmental concern is also going to be producing a sort of a block in the growth of this coin. Or after sometimes the government may feel that it is creating a lot of environmental this thing, and it may not be. There might be some regulation. Which cannot allow it to go on like that, and that's also a possibility. If Elon Musk can think about this, why not the governments?
So like the crypto mining, I said, it requires a lot of supercomputers, a lot of energy for a single Bitcoin. It's not very cost effective and very environmental this one. So what happens is they're going to stop the cryptocurrency mining by 2040. That is the limit, wherein now it is the number of coins which are mined are coming down. So what is there in the circulation is what is circulating now. Almost 90% of, say 80% of the Bitcoins which have to come into circulation have come in. Okay, so the newer coins like Cardano, which are usually more environmental friendly, are the ones which are picking up traction. So these are the ones which will eventually replace Bitcoin down the line. Okay,
yeah, so that is again another risk. So the won't be any erosion in the value of the Bitcoin. Then people just forget about Bitcoin.
No, I don't. What I mean is not in the value of the Bitcoin. What I mean is replacing Bitcoin as an alternative for functionality purposes, not in terms of value addition. Like a Litecoin, see, it does the same work as Bitcoin at a lower cost, lower transaction time, lower energy spent. So that kind of a replacement I'm talking about, not as a storage of value for Bitcoin, because Bitcoin is very large, 40% of the market capital. A small one cannot come and replace the whole thing. Okay, and it will take time even for your Ethereum and the other things to come and replace Bitcoin. It will take some time, and by that time the whole market will grow. It is like a single stock, like how only TCS or this one will not determine the whole Nifty 50. As the other stocks grow, they will take over the whole capitalization away from your Reliance and HDFC Bank. So that is what I'm talking about.
Yeah, but the other thing is, Biju sir, I mean, irrespective of environmental reasons or any other reasons, no government is going to have a favorable view on cryptocurrency anyway, because it's basically completely against fiat currency, and every government runs on fiat currency. I mean, every, welfare measure, everything basically runs on the ability that you can actually print money, right? Yeah. So, irrespective of environmental issue, environmental issue is still controversial, because there are people who would argue that, look, what is the current system we have? We have the banking system that is centralized. Can you imagine the number of real estate and infrastructure that you need to run the current banking structure, and the electricity and all the energy that is required to run it? It should be much more than any cryptocurrency. So, I mean, environmental issues is probably, I mean, with Tesla, the problem was that they were marketing their cars as, environmentally friendly, and therefore it was a kind of a dicey situation for them. That on one hand, because Elon Musk is a big person on decentralization and free speech and all such very very liberal things, and suddenly that is the reason why he decided not to accept cryptos.
No, would it be like a country like Russia or even India? Would see cryptocurrency as a way to come out of the SWIFT system, like everything controlled by the US, or so. If you take that into consideration, would there be governments who would be actually supporting the cryptos
So what happened if you see the recent Russia-Ukraine war? So one of the things which have changed after the war is now Russia wants to sell its oil and its this one in its currency or in other currency apart from US dollar. So what till now what was happening was the dollar was the central trade point for all the countries. So whatever international transactions had to happen, it had to happen through the dollar, which was one of the US way of controlling the entire market. So wherever there was oil, there used to be US. Iran, Iraq, you see the Iran, Iraq, you see your Ukraine crisis, everything is because
they prevented euro from being
exactly. They don't want any other thing. So now what happens? One more thing smartly the US government is doing is they have also the USDT. Okay, so which is a cryptocurrency which is pegged to the dollar. Okay, so that is one of the ways of entering, and they're also getting it centralized. Having the market like capitalization of USDT increasing day by day is only strengthening the US dollar. Okay, so all these is what will change with Web 3.0. All these will change with DeFi systems. All these are what going to change with the metaverse, NFT platforms which are going to come with the Web 3.0. That is what it promises as of now. So it is only time will tell how much it happens. That is what we have to see.
Rohit, let's go back to something less high tech. Mutual funds. Like, I mean, there might be people who won't want to check the Sharpe ratio, all those stuff. They just want some advice from any of you. See, just tell me. I mean, that's what Gopal was looking for, or Mahesh was looking for. I mean, select some mutual for me. I'll put it in that. Would it be a right way to because okay, I mean. Rohit knows everything about it, or Swaroop knows whatever they select. Will go for. I'll put 10 lakhs or 20 lakhs, 20 lakhs, 20 lakhs in 3. Okay, 60 lakhs. I'll forget. So, would it be a right way to go about in investing in?
So first thing I want to advise is if somebody who doesn't know anything about the market. So have first try to create a portfolio, have a diversified portfolio. So again, I said the 100 minus age rule. So if your age is 40 years, 60% of your assets have to go into equity. 40% has to be in a safe instrument, like a debt instrument, like an FD instrument. That is the first rule I would ask to follow. Okay. The second thing is have a portfolio of 3 to 4 stocks. So I showed you how we can select the stock. It's very simple. So see all these, just share it again. See, all these are available on most of the platforms. I'm just showing it on Money Control. See, finding a rating, CRISIL rating will not be an issue for you. And again, these returns and the analysis I've told you just have to see which is the highest. Okay, we just have to see the Sharpe ratio, which is highest, and its performance in comparison to this one. So you can what I would suggest is go for just mutual funds. So have one large cap. If your equity profile should have a large cap, an ELSS, and either a small or a mid cap. Why I would say that is because see the scope for a small cap to become a mid cap is higher than a scope for a mid cap to a large cap being higher. Because what happens is there is a common pool of the Nifty 50 which happens both with the index funds and your mid cap funds. So I would prefer to have a ELSS, a large cap, and a small cap. Again, you can just go here. You can see the rating of the fund. You can see the performance of the fund. 5-year, go for the top fund. Either you can go based on the rating of the fund, or like I said, see the other parameters. Okay. So it is just 4 to 5 parameters. You'll have to spend around 10-15 minutes. Only you will find out the best fund there.
Can I add to what Rohit said?
Yeah.
Coming back to your question, Dr. Sreeni, in terms of, let's say a person does not want to spend any time on doing any kinds of analysis, right? Just wants to, keep blinders on, go invest somewhere. One approach could be to go with the ETF model that Rohit mentioned, right? So typically there are 2 ETFs in India which are extremely liquid. One is Nifty Bees, which invests in Nifty 50 stocks, and there is Nifty Junior, which is the Nifty Next 50. Now these typically have grown at a rate of about 12 to 15% or 12 to 16% over the last 20 years. Right. So if a person, assuming the person who is investing does not want to do any kind of analysis, just eyes closed, want to do an SIP every month, but is expecting about 12 to 14 or 12 to 15%, those 2 could be ones to invest going forward for the next about 10 to 15 years.
How do you do that?
Yeah, that is a problem, Swaroop, because you see the people like Sreeni talked about, they have they have no idea about mutual funds, they have no idea about shares. So you have to invest in ETF. You have to start a demat account. They think of this as now a hurdle. I have to start a demat account.
Demat account is very simple. It's like opening
I know. But I would suggest is, why don't you simply invest instead of the Nifty Bees in a Nifty 50 index fund?
Absolutely, that's a good idea too. And you don't even need a demat account for it.
Yeah, instead of the Nifty Junior, you can put it in a Nifty NN50 index fund. There are many UTI, HDFC, all these index funds. So you don't have to think about anything. But the problem again is eventually, finally, I mean, the first fund, I mean, we take the list of top funds, you take the first fund and the 10th fund. I mean, how much is there going to be a difference?
1 to 2% only.
1 to 2%. So over 20 years, I mean, it's more important to have a proper asset allocation rather than choosing the top first fund or the top 10 fund, the 10th fund or the 7th fund. It is to have a proper asset allocation. And the rule of 72, not rule of 72, age minus, that particular calculation is applicable for a lot of people. But again, it would not be applicable for somebody who is going to invest for a first time. I mean, you talked about Gopal. Now, Gopal wants to invest. Can you imagine the amount of money he has? I mean, Gopal is a multi-millionaire, I suppose, already. So, I mean, he has to invest a huge amount of money for the first time if he wants to go up to 50 or 60%. And nobody is going to do that. That is the problem. So he has to start small and slowly, over a period of time, scale it up. But I'm not even saying that, for example, I don't follow the age rule. I have a system slightly different, which is called a systemic asset allocation, where there are some indicators I follow, like the Nifty, PE, the movie index, etc. And depending on the markets heating up or markets being cool, the asset allocation varies. So in my case, for example, in the markets are very heated, I generally keep my equity exposure at only around 25 to 30%. And when the markets become very, markets crash and when the value goes down, I basically do a transfer from my debt to this thing. I feel that is a more, a less heartbreaking way of investing, because the volatility will be a little lower. Though the eventual returns, there have been lots of studies, whatever methods you follow, eventually the returns are not going to matter. But how you arrive at the returns might matter. Your graph may not go up and down like it does. I'll just give you an example. When during the COVID crash, my indicators were telling me that I have to increase my equity allocation to nearly 40-45% at that point of time. But the problem with the COVID crash was it came back also very, very fast. And while I was in the process of transferring, again, the markets came up, at a very, very fast pace. But using a systemic allocation can actually reduce your heartburns and chance of heart attacks. But if you are going to suddenly put 60% in index funds and market crashes tomorrow by 40 or 30% over the next 6 months, Gopal will actually beat all us up.
That's a very important point, because many people get hurt because of this. They just listen to one talk and suddenly come in with a lump sum amount and select the fund with the highest return and invest it. They must be in probably at the top of the market. The next day the market crashes and the things come down. So a lump sum going in at this stage when the market is very heated up is, I think, is very risky. So I think if that is the way, they should actually wait for a correction of at least 10%, 12%.
So I showed one slide. I just want.
That's very true, Dr. Biju, right? Because I think, back to the slide that Rohit was sharing, there are some that show, 49% return over 2 years, right? Now, someone can look at that and assume that the fund is going to do that in future as well, whereas that's no certainty at all. Generally the law of numbers, law of averages catches up over a period of time. And that's where, Dr. Biju, you were saying how ETFs over a long period of time can give the same return as some of the best mutual funds in the country, right? So I think someone, unless they have some knowledge of it, it's better to follow the model that Dr. Kiran said, which is take some of these index funds, index Nifty, Next 50 funds, and kind of keep doing an SIP. My experience has been that SIP over a period of time is definitely one of the best models for a layman, if you will.
Yeah,
there is no point in timing the market, right?
Yeah.
Yeah, I want to add one more thing. Time in the market is more important than timing the market. So majority of them think I'm going to invest when the market is at the absolute bottom, or I'm going to sell out when the market is absolute top. Okay, so that never happens. Okay, so it is impossible with the best of the indicators to exactly time the bottom of a market or the top of the market. So during the COVID crash, I was 100% sure the Nifty will not beat 10,000. Okay, despite all the indicators, and this one in a couple of days it went to 7,000 and then came back to 10,000 immediately. So it is impossible for anybody to time the absolute low of a market or an absolute high of a market. So what is more important is time in the market. So the number of years you spend accumulating wealth is what is going to have a compounding effect, rather than just putting a bulk when the market is low and just withdrawing when the market is high. That never happens. That wealth creation never happens that way. So if you see Warren Buffett, the amount of wealth he created, 99.9% of the wealth was created after his age was 65 years. So what I'm trying to say is he started investing when his age was 11 years, but 99.9% of the wealth was created after 55 years of investing. Okay, so true wealth creation will take a lot of time. So you have to give it time. It doesn't happen overnight. Okay, so time in the market is more important than timing the market. So that is very important. So having a systematic, disciplined approach of having SIPs month on month for either ELSS or your small cap or your index fund or your NPS will over a period of time create more value in wealth accumulation than timing up and down. That and there was in fact there was one of the papers which showed that over a period of 20 years, no matter what, if you buy it at the absolute bottom, you're putting your SIP amount in the absolute bottom, it does not matter. If you have regularly on every first of a month put your money in SIP, the return generated is almost the same, hardly a 0.25 or a 0.5% difference, which eventually will not matter. Okay, so being a more disciplined investor will generate more money rather than running behind the up and down market.
Now, having said that, where do you feel the market is going to go in?
It is immaterial. It is immaterial.
I understand. For investment, but theoretically, where do you see it going?
See, the next 10 years, I'm extremely bullish on the Indian market because the scope for growth, India, it is going to come into the top 2 economies. Currently, you can see the GDP growth happening, and with the PLI schemes and the other schemes the government is supporting. Definitely, the next 10-15 years, I'm extremely bullish on India. So I'm very, very small. In fact, whatever US NASDAQ I was putting, I've reduced the allocation and I'm putting more money into the Indian market. Okay, because the next 10-15 years, the growth we are going to see is what is going to be humongous, because the scope for growth is there. We have the manpower, we have everything is available at our this one. And also, if we adopt technology faster, and we are in the technology forefront, be it IT companies, be it CPaaS, be it SaaS. So we are leading. You see Tanla platform, you see Tanla delivering 10,000 SMS for the COVID app. You see the way we delivered the vaccination for the whole country of say 100 this one so successfully and so fast. So that shows the scaling which can happen in the future also. Okay, so I'm currently extremely bullish, and you never know. Again, the growth happens. It doesn't happen uniform. It is always exponential. At one point, you see Chinese growth for the last 10-15 years, it just exploded. So from nowhere, it exploded, and it's the second largest. And in future, it's going to be the largest economy also. So I see India there.
Sreeni, from a practical perspective, the problem is, as Dr. Rohit has already said, we are already very, very, very late into the investing game. I mean, as doctors, generally, we are going to be very late in the investing game because we start earning very late. And from a practical perspective, I think the biggest problem for people who have to enter into the market is that if they want to enter into the market and want to make a meaningful return in the market, they have to allocate quite a huge percentage to equity. You can't invest 1% or 2% in equity and expect, even if the equity rises by 200%, and what is the net effect on the portfolio? It's hardly going to be anything. So you have to invest a certain percentage. And that is the biggest problem. There is no easy solution there. That is the problem, because unless you invest, I mean, there is if you go by the old guru of Warren Buffett, Benjamin Graham said that at any point of time, you should have minimum 25% in equity. And he was generally of the principal idea that you should have at least 50% in stocks and 50% in bonds. But the rock bottom for him for the most conservative investor was 25%, because it is only when you are at least 25% where the net portfolio is going to have any impact if there are gains. So when people are starting, that is going to be a big problem. And when you are starting for the first time and they, let's say, put 5% of the portfolio, when you're talking about a doctor at close to 50 years and he wants to invest 5% of his portfolio, you are talking about lakhs of rupees. And then in another 6 months, imagine the market goes down. The problem is, it is very difficult from a psychological perspective to hold on to it. If you have the ability to hold on to it, you will gain, but then that is going to be a problem. And there is no easy solution. I can't think of any easy solution for a person who wants to start investing at this age.
Yeah, a final word from Swaroop, and it's been
one final question, Swaroop. I think there is a 1% TDS on crypto transactions effective from this financial year. For
Yes.
transactions. So how is that going? I mean, that should be a big nightmare for accounting. And
that is absolutely correct, Kiran, because I think what has happened, especially in this crypto space, is the rules have been developing, over a period of time. And especially, the recent budget is where they formally spoke about crypto and the taxation and things like that. So yes, the accounting around the crypto is going to be a nightmare. The taxation around crypto is also not in line with the other rules of income tax as well, right? So for example, I was talking about capital gains and set off of losses against profits. There was one thing that said that if I, let's say, made a profit on Infosys and I made a loss on TCS, I can set them off against each other, so I don't have to pay. Whereas that's not how crypto works today. So if I make a profit on Bitcoin and I make a loss on Ethereum, I cannot set them off. I have to still pay tax on Bitcoin.
Yeah.
Right. So similarly, back to the 1% TDS that you said, who is supposed to kind of deduct it, and how is it going to be remitted to the government, and how are you going to account for all of that, right? So there's a lot of
idea
happening around this.
I mean, and the cutoff is just 50,000 rupees a year. So I mean, anybody who even dabbles a little, like I do, dabbles a very little, 1% of my portfolio, much lesser than that. In fact, mostly to understand technology. I don't invest like Rohit said. I dabble in it to understand the technology, just to be part of what you call as a cool system. So even if I lose all the money, nothing happens to me, something like that. Right. But then suddenly, even 50,000 rupees in a year, anything above 50,000 rupees in a year, the buyer is supposed to do the TDS. I don't know.
Yeah. So typically the buyer would be in this case, right, kind of doing that. So whenever I pay money, right, that's where the TDS gets deducted, right? I'm supposed to deduct the TDS and remit it and then pay the remaining money, right? But I think generally, if you take historically how things have worked, the limit of 50,000 may be revisited by the government. See, a lot of things in crypto, government introduces something slowly and then kind of increases the, or reduces the control over it. So tomorrow they may increase that 50,000 to, let's say, I don't know, 2 lakhs or something like that. We don't know at this moment, so we cannot speculate. But definitely, once they get a little more comfort, they will relook at it. And I think that will be an area that will keep coming up in budget year after year now, because that will be something that people will look up to, right? And like what Rohit said, the total value of investment in crypto in India alone is so huge that government cannot afford to overlook it.
Right. Thanks.
I'm really happy that I selected Rohit and he suggested Swaroop for this meeting. It's been absolutely wonderful, absolutely brilliant minds. I mean, I always love these brilliant minds, and in ophthalmology or wherever. And we had 2 brilliant people from KSOs also, Kiran and Viju there. I loved it, and I'm sure that people are going to watch it over and over again, and I'll be sharing it widely because it was really good. You keep seeing again the presentations that Rohit did and Swaroop did. There are a lot of points that you can pick up as a novice or somebody is already doing this. Thank you all for being part of this wonderful session. I think we will wind up the meeting. Thanks.
Thank you. Thanks a lot for having us here.
Thank you, sir.
Thanks, Rohit.
Thank you. Thanks, everyone.
Thank you. Bye.
Thank you.